Hi Rana, welcome to another session of Manifested Online Classes. My name is Joseph Kemani, your lecturer for Financial Reporting and Analysis. So in this session, I want us to look on an illustration question regarding accounting for the conversion of a partnership into a limited company. And I want us, first of all, we go through that particular question and we see what was required. So the question reads, Chada, Pete, Kidore are partners in a partnership business, sharing profit and losses in the ratio of 2:2:1 respectively, after allowing for a 10% per annum interest on fixed capital balances and commission entitled to a partner. The following trial balance was extracted from financial record of partnership as at 30th of September 2017 is as set below. So we are given the trial balance there for partnership as at 30th of September 2017. So the first item, we have landed buildings at cost, motor vehicle at cost, office equipment at cost, furniture and fixtures at cost. And then we have the provision for depreciation for buildings, motor vehicle, office equipment, furniture and fixtures. So this is the accumulated depreciation for those particular assets. Then we have investment. We have goodwill inventories as at 30th of September 2017. We have account receivable, account payable, bank overdraft, accrued expenses, a capital account for Chada, Pete, and Kidore. And then you're given the net profit for the year which ended 30th of September 2017. We have the drawings by the three partners, Chada, Pete, and Kidore. And then we have the current account for the three partners, Chada, Pete, and Kidore. Then we have some additional information, note 1 up to note number 3. Note number 1, we are told that Kidore was the only active partner and was entitled to a commission of 15% on annual sales revenue, which averaged to 20 million. So, and then you're told that number 2, the partners resolved to convert their business into that of a company to be named Chapeki Limited with effect from 1st October 2017 under the following terms. 1, we are told investment comprised equity investment which partners had acquired jointly. Each partner was to take over a portion of the investment equivalent to the profit share. The investment had a market value of 50 million as at 30th of September 2017. The other point, you're told other assets and liabilities were transferred to the new company at the following agreed values. Landed building 115 million, motor vehicle 25.5 million, office equipment 43.5 million, fixture and fittings 29.55 million, and then inventories at a book value less 5%, account receivables at book value less 2.5%, and then we are told current liabilities were transferred now to the company at their book value. We are told goodwill was considered valueless and therefore was written off. And then we are told the purchase consideration on business purchase was agreed at shillings 250. And the last point of note number 2, we are told the partners were to become shareholders. The company issued ordinary shares at par of shillings 10 each to the partners to satisfy the balance due to them as at 30th of September 2017. And in the last point, number 3, we are told upon incorporation, the new company issued new debentures at par carrying a 14% per annum. And then you're told the cash proceeds from the issue amounting to 50 million were utilized to purchase additional stock of raw materials, additional stock of raw materials worth 15 million, and then you're told accrued expenses were settled in full. So what you are required from this particular question 1 is we prepare the realization account, partners capital account, and Chapeki Limited account to cross off the partnership books. And finally, we are required to prepare opening statement of financial position of Chapeki Limited. This is a question for conversion of partnership into a limited company. Basically, what we said in our first lesson is that whenever a partnership business has been converted into a limited company, the first thing we need to do is to cross off the books of account of the partnership business, simply because that partnership business is dissolved. And actually, we said we prepare three main accounts: realization account, partners capital account, and the purchasing company account. Like in this case, the purchasing company is known as Chapeki Limited. Those are the three main accounts which we prepare to cross off the books of account of the partnership. And actually, that is what the examiner was requiring as far as Roman 1 of that question is concerned. And then from there, we proceed and then do what? Open the books of account of the new what? A company. So therefore, what we need to do is to start with Roman 1 of that question, whereby we are required to prepare a number of accounts. So the first account we are required to prepare is the realization account. Realization account, that is the first account we are expected to prepare here. And the realization account, basically this is prepared using a T format. Also in Roman 1, we are required to prepare a partners capital account. Partners capital account. Partners capital account. Equally, this is a T account. A T account. So meaning that this account will be having a debit and a credit side. And on the credit side, we are going to have the details column and columns equal to the number of partners. In our case, we have three partners. That is, we have three partners, Chada, Pete, and Kidore. The same case with the debit side of this particular account, we have three columns for the three partners. This is the debit side, credit, the same case with the partners capital account. So this is the details column, and then we have three partners, Chada, Pete, and then we have Kidore. The same case on the debit side, Chada, Pete, and Kidore. And equally, in Roman 1 of that particular question, what the examiner was requiring us we prepare is another account which is called Chapeki Limited. So remember, Chapeki, this is a new company, and basically the new company we refer to it as purchasing company. The reason being that this particular company is purchasing the business of the partnership. So therefore, we have the other account which is Chapeki Limited account. Chapeki Limited, but which you are saying is the purchasing company. Purchasing company account. Purchasing company account. So those are the three accounts which the examiner requires to be prepared as far as Roman 1 is concerned. And these accounts basically are prepared in order to cross off the books of account of what? Of the partnership. So what we need to do before we cross those particular accounts of the partnership, maybe we can just go through the additional information. We see what we are told. And number one, you're given some information about the commission which Kidore was to be entitled to, which you're told it was 15% of the sales revenue. And we are told Kidore is entitled to that commission because he was the only active partner. Being active partner means that Kidore is the one who was running the affairs of this particular partnership business. So we have that information. And then in number two, we are given now the information or the terms of conversion, the asset which were taken over by the new company, the asset which were taken over by the partners, the purchase consideration, and so on. So therefore, what we need to do, or anytime you come across such a question for partnership and whereby the conversion is taking place at the end of the year, the first thing you need to do is to distribute or basically to appropriate the profit which was reported by this particular partnership business among the partners, partners. Once you're through with that, then proceed and you cross off the books of account of what? Of the partnership. And basically, in this case, we do that by preparing something called the appropriation account, so that we can be able to do what? To distribute now that particular profit which was reported by the partnership business among the partners. So therefore, let's first of all we do that. Before then, we can proceed and cross off the books of account of this particular partnership business. It is also important for you to note that the figures which are given in the trial balance are in thousands of shillings. So therefore, what we need to do first of all, we take the net profit which was reported, the net profit for the year, and the net profit for the year in our case we are told is 91,000. So remember, take into account this is a partnership business. This profit which was reported during that year should be shared among partners. But before sharing out that particular profit, there are a number of things we need to deduct from this particular profit. Things like interest on capital, things like salaries to partners, things like commission to partners, and so on. So in a case what you're given, in the additional information number 1 is the commission to Kidore. So mean that here we less now the appropriations. So the first appropriation we are going to less is the commission to partners. So in our case, we know that it is only one partner who is entitled to a commission, and that is Kidore. Kidore was entitled to a commission equal to 15% of the sales. And in this case, we are told the sales for that year average to how much? Average to 20,000. So we get 15% of that, and automatically that should give us 3,000. Let's just confirm whether that will give us 3,000. So 15% of 20,000. Yes, that will give us 3,000. So this is a commission now which Kidore was entitled to. The other appropriation which we deduct from this is salary to partners. As per the information which are given in this particular question here, there is no partner who was entitled to a salary. But if any of the partner was entitled to a salary which is an appropriation, we also deduct it here. The other appropriation which we deduct here is something called the interest on capital. There is some information which are given regarding this, which is in note number or in paragraph 1 of that particular question, whereby we are told partners were sharing profit and losses in the ratio of 2:2:1 after allowing a 10% per annum interest on fixed capital balances. So mean that the partners were entitled to an interest of on capital equal to 10%. So let's compute the interest on partners, or the interest on capital, that is for each partner. For a Chada, which will be 10% of his capital. Then we have Pete, equally 10% of his capital. And then the last partner, who is Kidore, equally 10% of his what? Of his capital. So how much is the capital balance for each partner? We have that is in the trial balance. And the capital of Chada here was 58,500. For the other partner, it was 37,000. That is Pete. And the other partner, that is Kidore, we have an amount of 31,500. So what we need to do, we get 10% of this. So this will give us 58,50. This will give us 37. It will give us 3,700. And then this will give us 31,50. So we get the total. We take it to the last column. So the total figure here will be 58,50. 50 plus 3,700 plus 31,50. That will give us 12,700, and equally that one should be deducted now from our net profit. Now, after deducting those three items, that is the commission to partners, the salary to partners, the interest on capital, the amount now which remains here, or basically the balance which you get, If a positive figure is a profit to be shared, but if it is a negative figure, is a loss now to be shared. In our case, I hope you can see here, definitely you're going to have a positive figure. So this minus those two figures, we're going to have a positive figure. We less from 91,000, we less 3,000 and 12,700. Yes, that will give us a positive figure of 75,300. Now, this particular figure here, this is a profit now to be shared by partners or to be shared among the three partners using their profit and loss sharing ratio. So, therefore, we have the share of profit, and this profit will be shared by the three partners. Chada, I think we can just use C for Chada, P for Pete, and K for Kidore. And this particular profit will be shared based on their profit and loss sharing ratio. As per the information we have in the first paragraph of that particular question, we are told that the partners were sharing profit and losses in the ratio of 2:2:1. So we need to get the total for that, which is 5, and the share of Chada is 2/5 times that figure, that is 75,300. The same case with Pete, 2/5 times 75,300, and then finally Kidore, 1/5 times 75, 300. So that will give us now the amount of profit which each partner was entitled to. So the first partner, we take 2/5 times 75,300, and that will give us 30, 120, and that's the same for the other partner. And the last partner will be entitled to a share equal to a profit share equal to 15,060. So then once we add all this, it should give us now this particular amount here, that is 75,300. Yes, and basically after deducting now these three items now from our profit there, we should get now 0. Maybe you can just confirm 91,000 minus 3,000 minus 12,700 minus 75,300. Yes, so that should give us 0. So that is the first thing you do. You take the profit now which was reported by the partnership, and then you do what? You distribute it among the partners. And once you do that, then you go back to the trial balance, and basically you cross off all those particular accounts which had balances at the end of the year, starting from the first item there, which is land and building. But even before you do that, you have to remember, we say that in preparing this particular account, the number of things which you record here. For example, when we say that all the assets which are taken over by the new company at their net book value, we debit them in this particular account. The other item, or basically on the other hand, we say that those particular assets which are written off, those particular assets which are taken over by partners, we debit them in this particular account. Also, in the realization account, we credit the liabilities which are taken over by the new company, and also in this particular account on the credit side, we record now the purchase consideration. So therefore, what we know as per the information we have in or as per the information we have in note number 2 is that a number of assets, including land and buildings, motor vehicle, office equipment, furniture and fixtures, inventories, account receivables, all those particular assets were taken over by the new company. So therefore, all those particular assets which were taken over by the new company, what we do is that we debit them in this particular we debit them in this particular account here. We debit them in this particular account here. The first asset is land and buildings. Land and buildings, and we debit that particular asset here at its net book value. So what will be the net book value? The net book value will be equal to the cost, which is 123,500, minus the accumulated depreciation, which is 20,150. So that will give us now the net book value. We're going to compute that. The other asset is motor vehicle. So the net book value is 80,600 minus the accumulated depreciation, which is given as 54, 600. The other asset which was still taken over is office equipment. The net book value will be 70,200, which is the cost, minus accumulated depreciation, which is 24,400. The other asset which was taken over was furniture and fixtures. The net book value will be 52 minus the accumulated depreciation of 18,500. So these are basically the assets now which were taken over by the new company, and those particular assets we have said in this particular account we debit them at the net book value. At the net book what? A value. So let's compute the net book value of this particular asset, starting with the first one, which is landed building 123, 500 minus 20, 150, which will give us 103, 350. The other one is a motor vehicle. We have 600 minus the accumulated depreciation of 54,600, which will give us a net book value of 26,000. So the other asset is office equipment, whose cost is 7,200 minus accumulated depreciation of what? Of 24,400. That will give us 45,800. And then we have the other asset, which is furniture and fixtures. The cost is 52,000 minus accumulated depreciation of 18,500, and that will give us 33,500. Yes. So we are through with those particular accounting for those particular assets which were taken over by the first of all, those particular non-current assets which were taken over by the partnership, and then below those particular assets, remember I've said we cross off those particular accounts. Don't skip any account. So then from there we go, remember you have dealt with those particular accumulated depreciation. Then from there we go to the investment. So there is some information we are given regarding those investment in point number 2. In addition information number 2.1, we are told investment comprised of equity investment, which partners had acquired jointly. Equity investment means that this is an investment in shares, and the partners had acquired those particular shares what? Jointly. So we are told each partner was to take over a portion of the investment, equivalent to the profit what? Share. And then you are told the investment had a market value of 50 million at on 30th September 2017. So this particular investment, which we are told include investment in equity shares. So in the statement of financial, in the trial balance, you can see that this particular investment had a book value of what? Of 44,800. But you are told this particular investment at the end of the year had a value of how much? 50,000. So automatically, this particular investment will be shared by partners at their market value. The market value is how much? 50,000. So, but now the difference here, which is the difference between 50,000 and 44,800. So this one, which is 52, is what? Is a gain on investment, or basically we can refer to it as a revaluation gain on what? On investment. So how do we account for that? So remember, investment, this is an asset. So therefore, the amount which was recorded in this particular account was an amount of how much? 44,800. Yes. So therefore, what we do, because we need to cross off that particular account, take into account those particular investments were taken over by partners. So we credit this particular account with that particular amount, 44,800, and now this particular gain of 5,200, this will be credited in this account. This will be credited in this what? Account. So basically what that means is that the double entry for this particular investment shared by partners, one, we debit the partners capital account at an amount of 50,000. Then we credit to account the investment account with an amount of 44,800. That's what you have said there. And then with the gain, which is the revaluation gain of 52, this would be credited in the account called what? The realization account. The realization what? Account. So therefore, the entries which we need to make here is what is affecting realization. So 5,200, we can refer to that as the revaluation gain on investment, which is a figure of 52. So we are not required to prepare the investment account, and then the other entry which we need to make is to debit the partner's capital account with an amount of how much? 50. Remember, we are told that that particular investment will be shared among partners using their profit and loss sharing ratio. The profit and loss sharing ratio we know is 2/5, 2/5, and 1/5. So therefore, we debit this particular account with the investment which was taken over by partners. And basically we take 2/5 times what? 50,000 for Chada and Pete. So this will be 10, and that will give us 20,000. And then for Kidore automatically will be what? Will be 10. So that is now how we account for those particular assets which are taken over by partners. We said debit the partner's capital account, credit the specific asset account. So then below investment, we go back to the trial balance. Below investment, we have goodwill, and equally there is some information we have in note number 2 regarding goodwill, whereby we are told goodwill was considered valueless and was therefore written off. Equally, we say that those particular assets which are not taken over by the new company but they are written off, we credit the specific asset account and then we debit the partner's capital account, equally using the profit and loss sharing ratio. So take into account goodwill was written off, that one will be debited in this account and then credited in a specific asset account using the partner's profit and loss sharing ratio. So the profit and loss sharing ratio for Chada and Pete we know is 2/5. 2/5 times the value of goodwill. So in this case, the goodwill had a value of how much? 26,000. So this will give us what? Let's compute that. We have 26,000 divided by 5. So this will give us 52 times 2. So which will give us 10,400. 10,400 for Chada and Pete, and then 5,200 for the other partner. So with that particular goodwill, then from there we have two other assets there. We have inventories at the end of there and account receivables. If we go to note number 2, we are told inventories and also account receivables. These are the other assets which were taken over by the new company. Any asset taken over by the new company, the books of account of the partnership, or when crossing off the books of account of the partnership, you debit such asset in this account at the book value. The book value is the value in the trial balance. So we have inventories. The book value, the value in the trial balance is 31,200, and then we have account receivables. Account receivables with a book value of what? With a book value of 25,400. So we are through with those two current assets, and then from there we have bank overdraft, accrued expenses, including account payable. There is some information we are given still in note number 2, where we are given the terms of conversion, where we are told all current liabilities were transferred to the new company at the book value. At the book what? Value. And actually those three items, account payable, bank overdraft, accrued expenses, all those are current items of current liability. So those three items of current liabilities were transferred to the new company. So we said in crossing of the books of account of the partnership, those particular liabilities which are transferred to the new company, what we do is that we credit them in this account, in the realization account at the book value. So we have three current liabilities there. Account payables, the book value for that is 62,400. We also have bank OD, bank overdraft. The book value for that is 17,550. And then we have accrued expenses, having a book value of 4,000. Having a book value of what? 4,000. So those are the three current liabilities which were taken over. And then from there we go to the other item, which is the partner's capital account. The partner's capital account is crossed off to this particular account. And you can see the partner's capital account in the trial balance is having a what? a credit balance. So therefore that is the first, or basically that one we cross it off in this account and we record it on the credit side. The capital account balance for the first partner is 58,500, for Pete that is 7,000, and then for the other partner who is Kidore is an amount of 500. So we have done with that, and then from there we have now the profit for the year. The profit for the year, we don't record it in either of these particular accounts, but what we account for is these appropriations, this particular amount which has been distributed to partners, because you can see this profit for the year was distributed among partners. That's what we account for. And all these items here, all these appropriations, they are recorded in this account, the partner's capital account. Anything which a partner is entitled to, including commission, including salary, including a share of profit, including interest on capital, all those items in this account, we do what? We credit them. So let's start with the commission.
Hello learner, welcome to Manifested e-learning platform. My name is FAM Lingwiri, and today, ladies and gentlemen, we are discussing about the financial modeling and data analytics paper, December 2023 sitting. The focus is on question 23, and you are presented with the following information right on the left of your screen here. You'll be given the stock name, Z-Term Kenya Limited, Car Assemblers, Ujenzi Centum, Cement, Kilimo Bora, Nairobi All Share Index, and you've been given the ticker symbol right over here. You've also been provided with the portfolio compositions, and all of these total to 100%. And how you can be able to just quickly check is by scrolling down over here, and you can see that the sum is 100% right here. You are presented with the weekly returns for all of those companies, or all of those 4 companies, including the Nairobi All Share Index. Now, you are required to calculate the weekly returns for each of the individual stocks and the Nairobi All Share Index, calculate the wage portfolio, the average portfolio return for the historical period. You're told to calculate the standard deviation for each of the individual stocks and the Nairobi All Share Index. Then you're told to calculate the standard deviation for the portfolio returns to assess its risk, and to calculate the beta each individual stock of the portfolio, which measures its sensitivity to the market movements. And you can see these are 20 marks. This is 20 marks question. So the way I've decided to arrange the information is to arrange it as you can see on the right of your screen over here, to calculate the weekly returns for each of the individual stocks of the Nairobi All Share Index. So we just pick average, not average A. You can see the average right over here, and the average of what? We want to pick the average for Z-Term Kenya, to pick the average values right here. Up to there, close the brackets, then you enter. So we're saying that the average return should be negative 0.2%. Let's put it to maybe say 2 decimal places. That 2 decimal places is up to there. And if we were to drag it moving towards the right, we wouldn't be wrong, because we're saying that it picks the average for car assemblers. You can see car assemblers, it picks it right there. So that's what they're saying, the average, the weekly returns is given to us right there, escape. We move ahead and answer part B of the question. You're told to calculate the average portfolio return over the historical period. We have been given the portfolio composition, and the portfolio composition can be linked with this top part right here. Portfolio composition is there. Enter, and we link it with all of them towards the right, Control R, like that, so that you can be able to pick the portfolio composition. Remember, we have computed the average weekly returns above here. So we just link it with up above there, and then we drag it, Control R, like that, the same values, excluding the all share index. Because this, all of these portfolio composition total to 100%, as you can see down here, we cannot be able to include the all share index into our portfolio. How do we get the average portfolio return? Pick plus, we open the brackets, that value times the average weekly return plus that value times that value, close the bracket, the portfolio composition multiplied by the average weekly return, close the bracket, and then we add finally the portfolio composition for Kilimo Bora, and we multiply that with the average weekly returns, like that. Oops, that, close the bracket, and we enter. So I think I didn't put open a bracket here, that's why it's giving me those values there. So we open a bracket over here, and then once we close it like that and we decide to enter, it will actually be okay. So we only want it into the 2 decimal places, so we just sort of reduce it like so to 2 decimal places, like that, 0.35%. Now once we've gotten our portfolio return as 0.35%, we can move on to part C. Calculate the standard deviation for each of the individual stocks and the Nairobi All Share Index. That's 4 marks. So average standard deviation would be, we pick STD, stud dev, not P, because we're not picking for the entire population. We want stud dev, standard deviation for the sample. So we double click that, and we can be able to just pick the value for these values here. We highlight this value for Z term. So we highlight it down like that, and it picks to calculate for us the standard deviation for Z term. And we move up over here like this, we can be able to see we already have that given to us there. And if we were to drag it moving towards the right like so, up till all share index, it will actually pick the standard deviation. Remember, for example, this one is picking the standard deviation of the sample for the index, for the Nairobi All Share Index right here. Part D, we asked to calculate the standard deviation of the portfolio returns to assess the risk. And we're saying for us to be able to do that, we will need to consider the weights. And the weights would mean that we've already had the standard deviation over here compared to us over here, but now we need to factor in the weights. And we're saying it's going to be, we pick that standard deviation times its corresponding weight over here. The corresponding weights were given to us over here. We can use that, or we can even use this portfolio composition right over here. So we close the bracket and we open another one over here so that it can actually pick the values as the way we want them. Then we add the standard deviation over here. I forgot to open the brackets, so we open it right above over here. You can see it on the formula bar here. So we open the brackets there, and then we multiply that with car assemblers, corresponding portfolio composition weight. We open the brackets, we pick Ujenzi Bora standard deviation, weekly standard deviation, times the Ujenzi cement over here. Then we close the brackets, plus we pick this value here and we multiply that against that value there. Open the brackets and we close the brackets like that, and we just click enter. So we can be able to put it in form of weights, and we can say it's about 06.02% standard deviation. So standard deviation of the portfolio is given to us there. So we pick the standard deviations of the individual securities and we multiply them by the corresponding weights. Then finally, we are asked to calculate the beta for each individual stock in the portfolio, which measures its sensitivity to market movements. The beta is given by covariance of the market and stock, so you can put it like so, covariance of the market and the stock. Then we divide that against the variance of the market, like that. And that's what we're saying we're going to do. Covariance of the market and stock, or covariance of the market. So we pick covar S, because we're looking at a sample, covariance, and we open it up right over here. Covariance of what? Covariance of the market. This is the market over here, so we highlight that part. Covariance of the market, and on the second array here we put the stock itself over here, bearing in mind, like that, covariance of the market and stock, like that, and you can see what we've done, covariance of the market and stock. So we can lock the one for the market, so we are saying this one for G is one that you can be able to decide to lock, F4 and F4. Why are we locking it? Because we want to ensure that the covariance of the market remains like that. And then we do what? We divide now, divide by, you can see the variance like this. We divide against variance, or we just put it like that, variance of the market. But now, before we do the variance like that, we can say okay, like that, because that's just the covariance, like that, because you can see from the formula by just the covariance. Then we continue and say divided by the variance, not var P but var S, sample, variance of the market, based by this variance of the market. So we pick the variance of these values here and we lock it. So press F4 like that and we close the brackets, that. There, that's our beta, 0.0932. And if we are to drag it moving towards the right, let's just confirm. Covariance, remember we have locked, that's the purpose of locking. This one, covariance of the market. Look, this one has moved from initially Z term to now car assemblies. You can check the previous one over here, escape, check the previous one, you see it is now currently at Z term over Z term here. Now we move on to the second one, it actually picks, but it remains, this one remains, the variance of the market remains, the covariance of the market remains. So we can be able to say that the model is foolproof. Control R. But let's see if we're actually doing this the correct thing. We want to try and prove if we were to pull it towards the right, if you're going to get a beta of 1. You can see we already have beta of 1. Beta of the market is always 1, because it's covariance of the market, it's covariance of the market against the market divided by variance of the market. We always have that value being 1 there. And so with that, ladies and gentlemen, we have come to the end of question 23. Thank you for being with Manifested Publishers. We are always here for you. Be blessed.
Greetings and welcome back, candidates, to the study of boardroom dynamics. Once again, I want to officially praise Kasneb for introduction of boardroom dynamics subject in the Certified Secretary's qualification. The candidates who study this paper are expected to gain knowledge, skills, and attitudes that will enable them to positively and effectively influence and effect changes in the boardroom in the context of the existing dynamics of the board. We are continuing with the lessons in boardroom dynamics. In the previous sessions, we defined boardroom dynamics. We went ahead to discuss the evolution of corporate governance, and we studied how codes of governance have evolved and why. We saw that the first widely recognized national code of governance was released in the United Kingdom in 1992 under the leadership of Adrian Cadbury, Sir Adrian Cadbury, that was titled The Financial Aspects of Corporate Governance, dubbed as the Cadbury Code, the Cadbury Code. And following a series of revisions on that Cadbury Code, under different chairs, candidates, we learned that the code is now administered by the Financial Reporting Center and is now known as the United Kingdom Corporate Governance Code. All right? The what? The United Kingdom Corporate Governance Code. That is the first national code. Then we learned also that the first international influential code was produced by the Organization for Economic Cooperation and Development in 1999. So we've studied all that, and we even saw why the codes of corporate governance were developed. We explained the reasons why and how the codes of corporate governance were developed. Then in our last session, we also studied the three phases of board evolution. The three phases of board evolution, beginning with the ceremonial board, which we saw that the ceremonial board is a board that performs its functions functorily. That is characterized by just routine and superficiality. We learned that ceremonial boards exist only to rubber stamp the decisions that are made by the CEO. Then we studied also, candidates, how boards have evolved from ceremonial boards to deliberated boards. Deliberated board up to what we now have in place, the progressive board. The progressive board. And we saw that the progressive board is a board that adds value to the board and the company in general. We described the features of the ceremonial board, the features of the liberated board, and also the progressive boards. Today we are moving on, candidates, to yet another interesting subtopic, which is known as the building blocks of a progressive board. The building blocks of a progressive board. Building blocks. Now, candidates, a board that is energized or a board that is active, as we saw last time, which is a characteristic of a progressive board, is not guarantee for good governance. The fact that a board is energized, or a board energized means a board that has enthusiasm, or a board that is very active, where members actively participate in decision making, that one is not a guarantee of good governance. Why? Because the bottom line is that liberated boards have an enormous opportunity to add value to companies that they serve. But they also run the risk of eroding value. And it's for that reason that boards must inject what we call urgency in accelerating their transformations. And there are three main or basic building blocks, three main or basic building blocks of a progressive board. Three. And candidates, after CEOs and directors, they organize where they stand in the evolutionary scale, they should be ready to take action on that diagnosis. And how do they do that? They should do that by understanding the three building blocks. The three building blocks which are highlighted in the syllabus here. There is group dynamics as the first block. The second block is information architecture. And the third block is focus on substantive issues. Three blocks. Group dynamics, the first block. Let me have them in some form of a diagram. Let me have building blocks. Building blocks. I've said the first block. The first block is group dynamics. Group dynamics. That's the first building block, group dynamics. Group dynamics. The second one I've said is the information architecture and also focus on substantive issues. The second block is building blocks, information architecture. And focus on substantive issues. Focus on substantive issues. All right, three building blocks. The first block is group dynamics. The second block is information architecture. The third block is focus on substantive issues. And I've said having a board that is very active or a board that is vibrant is not sufficient for a board to have what we call good corporate governance. It's not a guarantee. The fact that the board is vibrant, the board is very active, that's not enough. For a board to exercise good corporate governance or best practices, that board must be built on three blocks. three blocks, right? The directors and the management should understand the three building blocks, which we are going to describe in our today's lesson. So by the end of this lesson, here is the objective candidates. You should be able to describe the three building blocks of a progressive board. Let's first describe group dynamics. Group dynamics candidates, the tenor of interactions among board members and between the board and management is fundamental in corporate governance. The interactions between the board members and the interaction between the board and management is a fundamental difference between a ceremonial board, a liberated board, and a progressive board. It's a very important point. You should note down that one. Because this lesson comes hot on heels of a lesson that we did in our last session, where we described the three faces of boards. Three: the ceremonial boards, the liberated boards, and the progressive board. So the interactions between members of a ceremonial board is not the same as the interactions or the dynamics of a liberated board and a progressive board. The tenor of the interactions among board members and between the management and board members is a fundamental difference between a ceremonial board, a liberated board, and a progressive board. So if you are to distinguish, if you are if you are to distinguish between the three kinds of boards, then one should be on the basis of group dynamics. Group dynamics means how the members of the board interact, the interactions, their behavior when they meet. All right? Then we shall come back to that later on. Let me first of all talk something about the information architecture. Now, candidates, how boards get what information they need and in what form is vital to how the board operates. And the mechanisms are typically different. When you consider the ceremonial board, the progressive board, and the liberated board. Information architecture refers to what information is made available to the board, that information is in which form, and so on. So how that information is relayed, whether it is relayed when they meet, or it is relayed sometime prior to the meeting. So those are the things that we are going to discuss, and that will also form the difference between the boards that we described in our last lesson. Then there is focus on substantive issues. Focus on substantive issues. Now, candidates, what the board focuses on, what the board spends its time on, will determine whether boards are able to add value consistently or not. Focus on substantive issues. And in reality, candidates, a wide range of behaviors and effectiveness occur in each phase of board evolution. All right? Each board has distinct characteristics regarding the focus, what they focus on. Focus on substantive issues. When I say each board, I'm referring to the three types of boards. The ceremonial board, liberated board, and the progressive board. And I've said that a wide range of effectiveness and also behaviors occur in each phase of board evolution. We saw how boards have evolved from ceremonial to progressive. And some candidate deliberated boards, for example, struggle with their group dynamics and with changes in their relationships with the CEOs. But others have excellent group dynamics. And while they struggle to balance their time around the central issues and the full scope of their responsibility. So the labels are very useful in understanding the dramatic differences between boards of the past, boards of the present, and hopefully boards of the future. But directors should recognize that there is a continuum within each phase. And within these building blocks, where the building blocks are in place, within the building blocks in place, a board has opportunity to make contributions that count. And progressive boards need to be aware of the mechanics. They need to be aware of these building blocks. Because as we learned earlier on, we learned that the progressive boards conform to changing rules and norms. But they quickly find a way to move beyond them to address more substantive issues. We learned last time that progressive boards go beyond compliance, contrary to the liberated boards and the ceremonial boards, which focuses only on complying with the corporate governance guidelines and legislation. The progressive board goes beyond compliance. So that's why if you sit on a progressive board, it's important for you to understand the building blocks of a progressive board. The first one is group dynamics. The second block is information architecture, and the third one is focus on substantive issues. And it's on the basis of these blocks that we can differentiate a ceremonial board, a deliberated board, and a progressive board. In our today's lesson, our focus is on the progressive board. So candidates, let's go deeper. Let's go deeper into the discussion of the building blocks of a progressive board. All right? Let's go deeper. Let's begin with group dynamics. Now, group dynamics, candidates, refers to the attitudinal and behavioral characteristics of a group. Behavioral characteristics of a group. Group dynamics refers to the behavioral characteristics of a group. Group dynamics, candidates, is concerned with how groups form, formation. It's concerned with formation of groups. Group dynamics is also concerned with the structure and processes. Structure and process. How groups are formed, the structure of the groups, the processes, and how they function. Functioning. How does the board function? Our group, we know a board is just a group, candidates, is individuals who come together to fulfill certain objectives. So when we discuss group dynamics, we are referring to how the board is formed, the structure of the board, the processes of the board, and the functioning of the board. And candidates, group dynamics are relevant in both formal and informal groups of all types. In an organization setting, groups are very common. Very common. One kind of a group is a board. And the effectiveness of a board depends not only on the quality and the diverse capabilities of individuals on the board, but also the quality of their interactions. Later on, we'll be studying the qualifications. We'll be studying how a board should be constituted. We'll be looking into matters like diversity. We'll be discussing issues to do with the skills, the competencies of those who should sit on a board. Diversity, qualifications, experience, and all that. The personal characteristics, all that will be discussed later on, and we'll be seeing why it's important to have, for example, diversity of experience, diversity in skills, diversity in gender, diversity in nationalities. All that will be discussed later on. But here we are saying that the quality, the effectiveness of a board does not rely on just the quality and the diverse capabilities of the individuals who sit in the board. But also, we are not saying that skills, competencies are not important, but over and above the qualifications and these other things, a board will be effective depending also on the quality of the interactions of this group. The quality of their interactions. Dynamics, quality, dynamics, candidates. Boardroom dynamics, we defined it as just the interactions, the behaviors of the members who sit on the board. Boardroom dynamics, you are referring to dynamics. The interactions. Previously, focus has only been on the qualifications of the board members, and we have had qualified board members who sit on progressive boards, but as a result of the poor dynamics, companies have not been able to fulfill their strategic objectives. So that's why we are studying here what we are calling boardroom dynamics. Here we're talking about group dynamics, which refers to the quality of the interactions. All right? So, candidates, group dynamics, I can't emphasize. And just to put it into context, we discussed the ceremonial board. We've said that the distinguishing feature of ceremonial boards, the liberated boards, and the progressive boards is group dynamics. We learned that in ceremonial boards, the board members were silent. So therefore, group dynamics was not an issue. We learned that after moving from ceremonial boards, we discussed the liberated board, where we saw that the liberated board, the members who sat on liberated boards were active. And sometimes too active. And their questions and their comments were highly fragmented. Here, candidates, the directors were unable to gel into a cohesive body and create what we call a unified point of view. A unified point of view for management. Because remember, the board plays an advisory role. The management looks to the board for advice. So in liberated board, we say that though they were active, they did not gel into a cohesive body. And therefore, they didn't come up with a unified point of view or message for management. And the whole, candidates, in this case, does not become greater than the sum of the parts. The whole should become greater than the sum of the parts. That was not the case with the liberated board. And what makes it challenging for directors to gel is the fact that the board are, unlike most other social bodies, and in several respects, they consist of individuals who are assembled without a final arbiter. And most teams have a clearly defined manager, a clearly defined captain, or at least someone who, at the end of the day, makes final decisions. And that person can be held accountable. And when a group hits an impasse or fails to produce or is held hostage by an incooperative member, the leader and team members have some recourse. But that's not the case with the board. Now, that is a distinction between a board and these other kinds of groups, because a board is a group. I'm saying a board may be put together by someone. They are just individuals who are assembled. You just advertise, then you have individual from this background, from individual from this, individual who has this kind of skills. Then these people are just brought together. And within that group of board members who are brought together, there may be no team, there may be no captain, just like we have captains in other forms of groups. All right? We're discussing group dynamics, the interactions, the building blocks of a progressive board. We've seen how ceremonial boards, there was no need to study group dynamics. The directors who are in ceremonial boards never used to make decisions. They were used only to rubber stamp the decisions of the management. I've also explained that moving from the ceremonial boards, we have the liberated boards, which are active and sometimes very active. Liberated boards. All right? So, candidates, we are discussing group dynamics. And we are discussing how group dynamics is different in these kinds of boards. All right? Now, moving on to the progressive board, candidates makes their group dynamics work as opposed to these other two types of boards. They do not end dialogue without making sure all voices have been heard and without coming to an explicit consensus on key matters. And many times, directors are aware that the group dynamics is failing in a progressive board. That board room dialogue is not satisfactory. They may come to that realization, but they don't know how to change. So they may sense that one or two other directors have their own agendas. I'm giving examples, candidates. So they may see a director or two repeatedly dragging the dialogue off on tangents, dwelling on insignificant issues, or always putting the CEO on the defensive. And candidates, whatever the symptoms, in the early stages of liberation, the boards return on time, as well as the CEO's return could also be slow. And increasing the length of meetings or holding more meetings sometimes may not help in such a matter. And the relationship between the board and the CEO, and particularly the power dynamics between the board and the CEO, is among the most essential elements of group dynamics. And on the ceremonial board's candidates, the problem is that the traditional CEO, the CEO is the one who holds all the power. But when a board moves from ceremonial to a liberated one, there is a flux in the power relationship. Here, the CEO cedes some power and authority to the board as a group. But as this pendulum swings, problems can emerge. When there is a swinging of pendulum, I mean when there is that shifting of power from the CEO to the board, when the CEO cedes some power to the board, there could be some problems that can emerge. And the first problem is that a board can overstep its bounds. Some directors may interpret their new mandate as the need to take charge and put down what they now see as the CEO's unchecked power. And we all know, candidates, that the purpose of a board is not to manage, but is to offer advisory. But when the CEO cedes some of his powers to a liberated board, some board members may take that opportunity to start performing functions that they are not mandated to perform. They may take advantage. But behaving in a way that tries to assert authority in the name of independence, as some directors on the liberated board do, creates an adversary board. An adversary board. Adversary board. Creates a what? Creates an adversarial board. An adversarial board. And the relationship between the CEO and the board at that moment becomes counterproductive. But the directors on a progressive board recognize that they are free to challenge the CEO, but they do not cede or take the powers of the CEO. That is the first problem, candidates, when a board moves from ceremonial to liberated. All right? Another problem could be, or could occur, when a board is not functioning well as a group and a power vacuum emerges. And we've seen CEOs who may ask their boards for input. But if the CEO speaks their minds without coalescing around a distinct viewpoint, and they expect the CEO to accommodate all their responses, the CEO's focus gets diluted. It gets what? Diluted. Another problem could be the power problem that can emerge among the members of the board itself. And we may find even cliques naturally forming within groups. And we can have long-serving members sitting together and dropping sideways comments or whispered conversations. And that can be distracting. And in the extreme case, a vocal director can form a coalition and drive issues forward without the board's consensus. And that has happened many times. Progressive and liberated boards. But candidates where boards gel together, where boards gel together as a group, power is not an issue on the board. It's not an issue. The power dynamics between the board and that of the CEO is not an issue. Because under that, where there is that gelling, the directors have what we call shared understanding of their purpose and mandate. And the board and the CEO understand their roles vis-a-vis each other's role. The board knows how to get consensus on its action items and how to provide input to the CEO and so on. And therefore, candidates' progressive boards also know that though directors need to be comfortable in challenging the CEO in order to perform a meaningful oversight, individual directors should not adopt an adversarial stance. Adversarial stance or position should not take an adversarial stance. And sometimes it is hard for directors to know how they can gel into an effective board. But the mindset of identifying the shortcomings and taking actions to improve is built into the self-evaluation process for progressive boards. But for liberated boards, self-evaluation is little more than a box-ticking exercise. That's not the case for a progressive board. And rarely does the liberated board draw out the real issues that block the board from making a substantial contribution. But progressive boards, on the other hand, are careful to include group dynamics, to include what? Group dynamics in the evaluation, and also use the process that makes it easy for sensitive issues to surface. And their whole approach, candidates, is to use self-evaluation to reinforce. Their whole approach is to self-evaluation, or that self-evaluation is used as an idea or as a process that can reinforce each director's ideas or contributions. So that's the difference between now the liberated board and the progressive board. Self-evaluation is not taken seriously for liberated boards, but in progressive boards they use that one so that they can bring out sensitive issues. All right? Progressive. All right? So that is the first block. I've explained the meaning of group dynamics and how these interactions play out within a ceremonial board, a liberated board, and a progressive board. Let's move on to the second block, which is information architecture. Information architecture is another building block of a progressive board. Now, candidates, information architecture describes all the ways the board gets information, whether it's communications from management, in preparation for board meetings, or planned visits by directors to company sites, and so on. How, it explains how or describes the ways the board gets information. We know that boards or the directors who sit on a board do not engage in day-to-day operations of an organization, but they rely on information that is provided by management. So information architecture describes all the ways the board gets information. That information can be through communications from management in preparation for board meetings, or that information can be gathered by having what we call planned visits by directors to company sites. And information architecture specifies what kinds of information the board will get and when the board will get that information, and also in what format. And how boards get what information and in what format is vital to how the board operates. It is vital to how the board operates. In other words, the mechanisms. In other words, I'm saying that the mechanisms are typically different when dealing with ceremonial boards, liberated boards, or progressive boards. All right? Ceremonial, liberated, and progressive. One way, in other words, to distinguish these boards is their information architecture. How does a ceremonial board receive information? How does a liberated board receive information? How does a progressive board receive information? When do they receive information, and in what format? That can be a basis for distinction between these kind of boards. And most directors would agree that no single director will ever know, no single board member will ever know a business as much as the management does. It's not possible for a director who sits on a board can understand a company more than the management or the managers, those who would run the business on a daily basis. That should be appreciated by each board member. There's consensus on that. Most directors will agree on that. And there is, in other words, there is simply too much going on in the company as well as in the industry for any part-time director to keep current. There is a lot of things that are happening. There are many changes that are taking place within the company and within the industry that the company operates, that a part-time director may not understand everything. All right? They cannot keep current. Board of directors cannot keep current with the changes that happen in the industry and within the company. And therefore, directors must continuously learn about the company, continuously learn about the company, and they must all have the same foundation of information. If the directors who sit on a board are to have any productive meeting, then they need to have common information. They must have the same foundation of information. Because board of directors, the board meets and makes decisions in a meeting. And these meetings are periodic. So before they assemble to discuss, they need to have same foundation of information for their dialogue to be productive. And if they cannot get the right information efficiently and in the right form, the best board dynamics in the world cannot help. We've described here the interactions, the behaviors, the relationships of board members as a group. We've discussed the importance of understanding the interactions between the board members, whether it is in deliberated board or progressive board. The point here is, as we discuss information architecture, it doesn't matter how efficient or how knowledgeable or how the behaviors or the relationships of the board members is good. What will help the board to achieve its mandate is information. There may be the best they may have the best dynamics of interactions, but if they do not have the same foundation of information, if they cannot get the right information efficiently and in the right form, then the best board dynamics in the world won't help them. It will not help them do their job. And most candidates of that information comes from management. It comes from management. The general feeling among candidates, the general feeling among these, the liberated board is that the reports they get before the board meetings do not fit the bill. Directors, you may find that in liberated boards, they are uniformly frustrated. Uniformly frustrated. Frustrated by what? Frustrated by the low quality of information they get. And sometimes they can even get 200-page documents that is filled with jargon from management. That information may be too much, a lot of jargon. The information may be poorly presented. And when they meet, they may find the liberated board members asking questions about the data that they received. And that leaves the directors unprepared for substantive discussions. And even if there is plenty of time for it, you may find that the directors are uniformly frustrated. And when the directors are all frustrated, the management will also likewise be frustrated too. That is the case for the liberated boards. Now, candidates, progressive boards, on the other hand, work with management to design in advance what information they need, such that the directors put their heads together. They put their heads together with the CEO, not only on what information is provided, but also how and when it is provided. That's what a progressive board will do in advance. And that way, the board knows what to expect and when to expect it. And that ensures that the quality, the timeliness, the content, and the format information facilitates insights and reactions from the directors. And by understanding the meaning and context of information, whether about the external environment or the internal environment, directors are in a position to discuss the future of the company as the information indicates, rather than discussing the meaning of information. we've seen that in liberated boards, the board members ask questions about the data, because you may find this data has full of jargon, this data is voluminous, and this data, voluminous means they have many pages to study, yet they have very little time to prepare. They leave, all these leave the liberated board unprepared. It's not prepared for the meeting, so that when the liberated board meets, the focus is on the data, the information. They want to understand the information. That's not the case for a progressive board, because the progressive board works with management well in advance. They design in advance what information is required, the information when is to be availed, such that the quality, the timeliness, even the content and the format of information facilitates insights and reactions from directors. A progressive board means, instead of questioning about the information, they've already understood the information, so this board can easily offer advisory, or it can react to this information and help the company move forward. This board can add value. Information architecture is a very important building block of a progressive board. All right? Rather than discussing the meaning of information itself, they give feedback because they've already understood the information. And getting the information flow right is a tremendous benefit to the management. You will not find management being frustrated by a progressive board. In fact, the board, the management will be satisfied. It's a tremendous benefit. The CEOs and the CFOs, for the most part, want to make the business transparent to directors. Right? But they don't want to spend their time explaining financial statements line by line. Because part of the information that may be required is, say, the financial statements, published financial statements. For progressive board, that statements, the two, management and the board will have agreed in advance on the jargon to use and the format and everything, so they understand. But liberated board, you find that the CFOs and the CEOs may spend most of the time explaining concepts to the liberated board. It's not the case for a progressive board meeting, because in that meeting, the CEO, the CFOs, they don't waste time explaining the statements line by line, the financial statements. So when the board and the management candidates are on the same page, when they are on what? When they are on the same page to begin with, that problem of explaining financial statements line by line is reduced, such that the progressive board spend time and effort giving feedback, adding value. And progressive boards spend effort and time outside the boardroom. They don't just wait for a meeting so that they are furnished with information. No, they spend time outside the boardrooms, learning about the business, learning about the environment in which the business operates. They take time with the employees and they analyze reports. They visit the branches, they visit the stores, they visit the manufacturing plants, all right? They find ways to do what? To keep their finger on the pulse of the company, which keeps their questions and opinions sharp and on target. And if you recall the features of, those are the features of a progressive board that we learned last time. because you cannot add value candidates when you are ignorant. Progressive boards are boards that are not ignorant. They have information. Part of this information is provided by the management, and they don't rely on just information from management. No, they spend time outside the boardroom learning about the company. They talk to employees, they analyze statements, they visit the stores, they gather the relevant information to help them carry out their function. I hope candidates, you appreciate the importance of this building block of a progressive board, information architecture. Then there is a last block, focus on substantive issues, right? Focus on substantive issues. What I may also call the substance of deliberations. The substance of deliberations. Now, candidates with the right, let me take my pen. Now, with the right group dynamics and efficient information flow, the board can get down to its work. Where dynamics means interactions, the functioning, the relationship between the group. If it is sound and that group has the right information, then that board can get down to its real work. And it's important that the board sees the bigger picture in terms of its total responsibility, what I'm calling the substance of its deliberations. And compliance with the rules of governance is a necessity. Rules of governance is what? Is a necessity. And what remains to be seen is whether boards will do more, will go beyond compliance. And many boards spend a lot of time discussing the minor issues or are bogged down in compliance. Either they are discussing minor issues or just operating to comply. Then they feel rushed when it comes to the real opportunity to add value. All right? So they cover important topics as they emerge, but wonder if they could do, or if they could be what we call maybe anticipatory or more proactive. And even though they may spend many hours outside the board on governance issues, directors have difficulty balancing their time and attention on the breadth of issues, because they may have limited time that they spend together. Some may spend together, or they may have 48 hours or 50 hours in a year. So that kind of time in a year could be very limited. So it's important to focus on substantive issues because of the constraint of time. And the CEO plays a very fundamental role here, because the CEO should help articulate the most important points and see if the directors agree, substantive issues. And either way, there must be shared understanding of what is most important and how directors and management will focus their limited time and energy on the substantive issues. So yes, it's important to have sound group dynamics. Having information architecture is also very important. having efficient information, the board can now start to work. But before the board works, it's important for the board to identify the substantive issues for deliberations. Otherwise, the board will be bogged down in discussing things that are not important. They may also be bogged down in just complying. Yet we know a progressive board goes beyond compliance. That's what we studied last time. A progressive board complies with the corporate governance rules, it complies with legislation, but it goes beyond, it adds value. It goes beyond complying, it goes beyond to ensure that the strategic objectives of the company are realized. So candidate, these are the three building blocks of a progressive board. The first block we've discussed is group dynamics. The second one, information architecture. The third is a focus on substantive issues. Go through the lesson one more time. If you have any questions, you can send the questions. I will give you one question assignment. Discuss the three main building blocks of a progressive board. Discuss in detail the three main building blocks of a progressive board. Now, candidates, we've learned also in this lesson that these blocks can be used to distinguish the three different types of boards: ceremonial board, deliberated board, and progressive board. That's what we achieved in our today's lesson. I've illustrated how a ceremonial board, how the dynamics of a ceremonial board plays out, how the dynamics plays out in a deliberated board and progressive board. This done likewise for information architecture and focus on substantive issues. In close here, I have demonstrated how the deliberated boards are not able to focus on substantive issues. I've also explained how the progressive board are able to surmount that problem of discussing the substantive issues, or what we call the substance of deliberations. They go beyond compliance. They do more than complying. They do not spend time discussing minor issues or getting bogged down in compliance, such that they feel rushed to the real opportunity to add value at the end. No, they don't do that. They decide earlier by the help of the CEO on articulating the most important points, and they agree on the substantive matters, such that they come up with what we call a shared understanding of what is most important. So thank you for your time. I hope to meet you in our next session where we continue to share knowledge in boardroom dynamics. Thank you. God bless you. Bye-bye. Bye.
Hello learner, welcome to Manifested e-learning platform. My name is FAM Ningwiri, and today, ladies and gentlemen, we are discussing about the business data analytics, December 2023, question 22. It reads as follows: Safari Limited is evaluating a project with the following details. You've been given the initial investment, 100 million, residual value, 10 million, year one projected project cash flows is 25 million, the annual cash flow growth rate from year 2 is 10 million, the project life is 5 years. You are required: A, compute the following project metrics: payback period, number 1, number 2, the net present value, assume a discount rate of 12%, number 3, the profitability index, assume a discount rate of 12%. B, using a graph, determine the project's internal rate of return. And this totals 30 marks. So trying to answer this question gives us or gives you 30 marks there in total. So to start us off, we are first of all going to do the following. We're just going to first of all come right here and we say we have the year given to us over here. Given to us over here. And this solution over here, you can just drag this one down over here. This is A. And this gives us year. So we have the years given to us there from year 0, 1, 2, 2, and of course you know what happens. Once you put it like this and then you have that plus sign like that, you can drag it up to the number of years you actually want like that. So let's assume it goes all the way to year 5. Not assume, we've been told it goes to actually to year 5. And you can be able to see the project life right over here is 5 years. So from year 0. And we are saying from there then we need then to put the value over here. We're dealing with Kenya shillings. So shillings, put shillings. And we are saying we can put them in thousands. That. All of these need to be put in terms of thousands over here. That. Why? Because we're dealing with thousands. We just do not want to deal with very big figures like that. We just want to deal at least with manageable figures. And from there, we can put over here the initial investment. That. Then we can put the initial investment right here as 100,000. Why am I putting 100,000? Guys, because you're saying that we are expressing it in terms of thousands over here. Yes, it's 100 million, but if you remove those 3 zeros there, we're saying we're dealing with 100,000. And because we want to deal with values that are in terms of the accounting format, so let's put it like that, then just do it sort of something like that. That looks at least well presented, presentable, I mean. So initial investment is that. Then we have the residue value or residual value. That. And the residual value is assuming that you sell the asset at the end of the project or after 5 years there. So right here I can put over here in terms of the residue value, you can put 10,000 here. You sell an asset and you realize 10,000 in terms of value. Once that happens, then we can move ahead and look at the values over here in terms of the net cash flows over here, the cash flows. Cash flows. And we're saying the cash flows over here we've been given the initial investment is 100 million. You're seeing the project 1 cash flows is 25 million over here. So assuming that this is, of course, is the initial investment, we can put a negative value over here like this. We're saying that we can be able to put, so it's negative, I just sort of put negative, enter, it can be able to appear, and that it's an outflow. We can put the values over here as follows. For year 1, we're seeing is 25,000. not right there. You can put, because this is the residual value, the cash flows here, 25,000. That, and we're saying this 25 million or 25,000 over here, in our case here, is going to grow at an annual rate of 10% from year 2. So from here, we can do sort of something like so. We add that value and multiply it by a factor of 10%. So times 1.1. That. We get 27,500. Then we just drag it, because this has got a formula. We drag it sort of like that, and we make sure at least it auto fits within the cells. So from there, we are saying that what is going to be our net cash flows? Our net cash flows are going to be as follows. Flows. Then, so here we're going to pick this value here. The ones we're going to discount, these ones are going to use this value here. And then we are saying we're going to use, just going to pick the residual value plus the cash flow itself over here, if any. So that now it, after period 5, we expect this cash flow to be 46,603 over here, to be the cash flow you're going to discount back to period 0. So we drag it and it picks. You can see now these are the cash flows which you're going to discount over here. You can put them in bold, Control B. That, of course, we can be able to expand it by sort of clicking, double clicking like that. Those are the cash flows. Once we have that, we can then get the payback period. So over here, I can write now the payback period. Because that's what you're looking for, payback period. This means that we need to get the cumulative. Cumulative values. I can be able to just put it sort of like that, and we come right here and put it maybe in form of a box like that. So that's what you're interested in, the cumulative cash flows. So here it's just going to be that value, and then we are going to pick plus that value plus this net cash flow here, comes to 75, and then we reduce it. We continue, we drag it because it's got a formula. We continue up to there. But if we continue over here, if we get 33,000, we subtract, because of or 17,000, we subtract 33,000, we should be able to get a positive value. What the payback period tries to measure is how much you can be able to recoup this original investment of ours over here of 100,000. So clearly over here we'll be able to get a positive cash flow, yes. But in terms of the payback period, in terms of years, you can see the number of years given to us right here. We can say that the payback period, so payback period over here will be given to us right over here. So this is year 1. We can say year 1, indeed, we're still getting a negative cash flow. Here, year 2, we're still getting a negative cash flow. Year 3, we're still getting a negative cash flow over here. But when we reach year 4, we are going to get a positive cash flow. This, let me just demonstrate. We're just going to get a positive cash flow over here like so. And that's not what we want. We want to recoup this original investment. We do not want a positive cash flow. We want to see the exact number of years we're able to recoup this 100,000 right here. So just delete that. We know it is going to be 3 years, but 3 years and how many months? So we can be able to put the number of months right over here, or we can be able to compute it right here. So it's going to be that value over this value, and then we multiply by 12 because we want it in terms of months. Like that. So 6.22 months. So the payback period you can see is, we can say, is here. Payback period is 3 years, 6.22 months. That is what answers our first part right here, the payback period. So we can move ahead to part B, the question over here. And part B, we can just go down right here. B. It's a similar fashion or a similar format. We are looking for the net present value right here at a discount rate of 12%. So net present value. Net present value. And we're saying the net present value is, just given, is just how much we are able to get. Are we going to realize a positive cash flow or a negative cash flow based on discounting? You're using a discounted cash flow technique so that you can be able to get the present values. And in a similar way over here, so we're not in B, we're doing part A, part 1. So this is A, part 1. I can just put it like so. This is A, part 2. A, part 2. Like that. So that now we can be consistent there. And to get the net present value, what we'll need to do, if you allow me to copy this over here like this, cash flow, the cash flows over here, I can be able just to copy these ones the way they are like that. Copy, just put them just down here. So, and of course, I'll be able to also copy this. Allow me to copy this. Copy, put it just down here like so. And this I can drag it maybe down. I can just drag it somewhere down there like that. So the initial investment, we pick it from above here. That's the initial investment there. No problem. The residual value, we just pick this from above here. And then we're saying the cash flows, we're just going to pick whatever we have right above here. So we're linking it like that. And we're saying these cash flows are the ones which we will need then to discount. So this is how we're going to discount it. So the net cash flows, we still pick them from above there. Net cash flows like that. And then we have this value like that. And this is what we're going to discount. These ones over here. These net cash flows. You see, like the way I've did over here, the relevant values, these are the ones which are we're going to discount and get the present values right over here. So present values. So the present values will be, we're going to get this value over 1 plus r over here. But for us to be able to get the present values, or in Excel, there's always a way we can be able to get the present values. Always. There's always a way how we can be able to do it. And we can just say the NPV. Instead of discounting this value over 1 plus the discount rate power 1, this value over 1 plus the discount rate power 2, power 3, power 4, and power 5 like that, we can just go to the to a formula NPV like that, and we are saying we open it up right here, and we can see the rate. The rate is just 12%. And once we have the rate as 12%, under the value 1 here, we put in those cumulative cash flows like that. And then we will need then to subtract the initial cash outlay. So would it be correct for me to add right over here? We add the initial cash outlay there like that. That's the initial cash outlay. So that's what we are saying we are going to have. 13 million, of course, because we're dealing with millions, 13,365,099. That is what you're saying represents NPV. And so you can maybe highlight the answers maybe in red like that, so that you can be able to know that these are the answers. We can move on and discuss about the profitability index. The NPV, before we move on to the profitability index, the NPV is the net of present values to try and see whether you're able to get a positive cash flow or a positive value or a negative value. If NPV is positive like this, we accept the project because the project is going to yield us positive values in future. But if you get a negative NPV, then it doesn't make any sense to us here. So here, part 3, I can move ahead right down here and now click this one to be 3, the third one. That. A, part 3. We talk about profitability index. That. Under profitability index, we are going to get the present value of cash flows divided by the initial cash outlay. That gives us the profitability index. Any number greater than 1 gives us positive, or we are supposed to go ahead and invest in that project. If it gives us anything less than 1, then we reject the project. And we are told to assume the discount rate of 12%. So what we do is that we just go ahead and use the similar values right over here. Copy. We come right here, or rather I should have copied from here, sorry. Copy, and you put it right maybe just down here. Paste special, we want to paste special formulas and all. Oh, it's refusing, so we just look for an alternative way, put it like that. So with these values, we can just link it with the first value right over here. So just link it with that one, that, and we can just drag it moving across like that. The residual value picks from here, that. So these represent the net cash flows. So this is what we're saying is shillings, so we just delete this and it's okay. But the initial investment picks from here, the net cash flows, that value there. So once we have that, then we can be able to get the profitability index. And the profitability index, we are going to get the present value of cash flows divided by the initial divided by the initial cash outlay. So we're going to use NPV rate 12%. The values, we are saying we're going to use these values here. And there's one thing that we needed to change here. We need to add the two values, these two values here, before we continue. That one plus that one there. See the profitability index, NPV. See here, double click it. Then we open it up right here. And you see the rate is 12%. And then with 12%, we can put in the values over here. like that. We are getting that value, the present value of cash flows, and we are going to divide this against the initial cash outlay. So minus, open the brackets, this one. Enter. That's what we get as our profitability index, 1.13. So in this case, we accept this one based on NPV, we accept, and the payback period, if it's the shorter the payback period, the better it is for us. So here, just like for consistency purposes, we put it in red like that. And we can see that we're moving on well, and we now move on to part B of the question. Using a graph, determine the project's internal rate of return. The project's internal rate of return is at the point where you get, the NPV is equals to 0. Where the NPV is equals to 0 is where we are saying our project's IRR is going to be. And so we're going to use a graph. So first of all, you're going to test it using the IRR formula. So IRR, or internal rate of return. Rate of return. The internal rate of return, IRR, is going to be, we open it up right over here, the values. So we put the values right over here, all of the values, including the negative value here. And we say, okay. So it's around 17%. And that's what we expect, or 16.75%. That's what we expect from using the graph, around thereabout. So we pick arbitrary rates, so 12%. You can put 12% over here, 13%, like that, and so on and so forth like that. So we just drag it. So we can just get arbitrary rates over here, and we get the corresponding NPVs. So NPV over here, 12%. The rate is 12%. You can see from right over here, 12%. The values over here are these ones here, the net cash flows here, like that. And then we do what? We add the initial cash outlay. The initial cash outlay in this case was negative here, that, and we get that value. So it's the same as what we got above over here. That's fine. But because we want to ensure that we want to get the corresponding NPVs at different rates over here, I need to lock the formulas over here. So I press F4 there. I click over here, I press F4, and I press F4 over here, so that I can be able to lock and ensure that everything is okay. So if I drag my formula over here, it should be able to work. So that's what I'm going to do right here. So shift, Control D. But it's picking 13%, or it's because I didn't change. You see, it's still at 12% here. So what I'll do, I'll just change this to 13%, 14%, like that, 14%, 15%, and so on and so forth. Just come and change here, 16%, 17, that, then 18. So don't worry about that. 19, Then here we got 20%, 20%, like that. So you plot a graph over here. This is the NPV. NPV, that rate. Like that. So just sort of put it center to make it look presentable, and like that. Then you can just draw a graph here. Insert. Then you come to recommended charts, and you can be able to see, based on this graph over here, that point, okay, just place it somewhere right here, that at around 16% over here, you can see at around this point here, if you click right here, it will give you the point. At around 17% is when you're going to get negative NPV thereabout. 17%. And you can see it's 16.75 right here. So the exact rate should actually be somewhere over here where it's next to. It's along just this curve over here. It cuts it along this axis over here like that. NPV indeed is at 16.75. So once you draw the graph like this, it should be able to, and then you just highlight like this, you can be able to see thereabouts around approximately 17%. You can be able to get the IRR. So ladies and gentlemen, this brings us to the end of the class. We have done question 22 of the business and data analytics paper, which came in December 2023. Hope you have enjoyed it. God bless you all. Bye bye.
Hello and welcome. It's always a pleasure to have you at the Manifested e-learning platform. Today's lesson, we are going to revise a question that was tested in August 2023. The subject is fixed income investment analysis. Question 4A reads, analyze 3 approaches used to gauge credit risk of a company. 6 marks. Analyze 3 approaches used to gauge risk of a company. Now, candidates, there are several approaches that may be used to gauge the credit risk of a company, and they can broadly be categorized into 2, the traditional approaches and the quantitative approaches. We are going to discuss around 5 or 6 of these approaches. The question required candidates to analyze 3. We analyze more than 3, starting with the financial statement analysis. That is the first approach. The analysis of the financial statements can help in gauging the credit risk of a company. And that involves a deep dive into a company's financial statements, including the income statement, the balance sheet, the cash flow statements, and so on. Here, candidates, analysts look at ratios like the profitability ratios, like the one on return on equity, return on assets. Analysts can also analyze the liquidity ratios like the current ratio, the quick ratio. We also have solvency ratios like the debt to equity ratio, and which can help assess the company's financial health. All right. So financial statement analysis is one way to gauge the credit risk of a company. So let's put down the approaches to gauge approaches to gauge the credit risk of a company. One is financial statements analysis of the financial statements. And I've given examples of how these financial statements can be analyzed. That can be done by looking at the ratios, the liquidity ratios, the like the current ratios, we may have the solvency ratios, and so on, activity ratios. That's the first approach. The second approach is what we call credit scoring models. We can use credit scoring models. Now, under the credit scoring models, we have the analysts assigning a numerical score to a company based on variety of factors, including the company's financial ratios, the payment history with creditors, the industry trends, and also economic conditions. So a number is assigned to a company based on the factors that I've mentioned, such that higher scores indicate lower credit risk and vice versa. So such models are often used by lenders to automate loan approval decisions. Credit scoring models. That's the second approach to gauge a company's credit risk. Expert judgment, number 3. The credit risk of a company can also be gauged by the judgment of the experts. Expert judgment. The experience and insights of credit analysts are valuable in assessing a company's credit worthiness. They can consider qualitative factors that are not easily captured in numbers, such as the company's management team, the competitive landscape, and also the future growth prospects. So experts can help gauge credit risk of a company by looking at factors that cannot be captured in numbers, like the competitive landscape, the competitive edge of the company, the future growth of the prospects of the company, the management team of the company, and any other quantitative factors. Then number 4, we have, these are the traditional approaches. We have other quantitative approaches, like the probability of default. Probability of default, the PD. Probability of default. This is a statistical measure that estimates the likelihood of a company defaulting on its debt obligations, and it's often derived from historical data and complex models that consider various financial and economic factors. Probability, a number is assigned to by considering historical data and complex models. It is a statistical measure that estimates the likelihood of a company defaulting. 5, loss given default. Loss given default. This is a metric that estimates the potential financial loss a lender might incur if a company defaults. It considers factors like the value of any collateral pledged by the company, and also the lender's ability to recover funds through bankruptcy proceedings. Loss given default is an approach that can gauge the company's credit risk. You may also have what we call the exposure at default. Exposure at default. This represents the outstanding amount of debt owed by a company to the lender at the time of default. All right? Exposure at default can be used to gauge a company's credit risk, because it represents the outstanding amount of debt owed by the company to the lender at the time of default. We may also have stress testing as an approach. Stress testing. This involves simulating various economic scenarios, such as recessions, such as interest rate hikes, to assess how a company's creditworthiness might be impacted under stress. You understand? A company is subjected to simulations, for example, by simulating a situation where there is an increase in interest rates. Then the experts check what will be the impact on the company's creditworthiness. The same can be done through simulations on recessions. So stress testing is yet another approach. So these are 7 approaches. 1, financial statements analysis. 2, credit scoring methods or models. 3, expert judgment. 4, probability of default. 5, loss given default. 6, exposure at default. 7, stress testing. This would earn the candidate 6 marks. Any 3 points, 6 marks. That is A. B reads, an investor purchases a 5-year 9% coupon bond that pays interest semi-annually. The price of this bond is 100 shillings and 108 shillings and 32 cents. The yield to maturity for the bond is 7% on bond equivalent basis. The face value of the bond is 100 shillings. Required, determine the following for this bond. Roman 1, total future value of money, 2 marks. Roman 2, capital gain or loss, 1 mark. Roman 3, reinvestment income, 3 marks. Total future value of money. So we read the price of this bond is 108 shillings and 32 cents. That is the present value. So what will be the future value of this amount? That is B, Roman 1. We know that future value is always equal to the present value times 1 plus R raised to n. That is the formula, future value. We are to calculate the future value of 108 and 32 cents. So what is the period here? The period n, we read that this is a 5-year bond. So the n here is 5 years. And what is the rate? The rate is the yield to maturity for this bond is 7%. Yield to maturity is 7%. But you also read that the interest is paid semi-annually, and therefore it will be 7% divided by 2, which is equal to 3.5%. So 3.5% will be our discounting rate. 3.5% converted into decimal is equal to 0.035. We raise to, it will be 5 years times 2. Why times 2? Because this interest is paid semi-annually. So we divided this by 2. When it comes to the period, we take 5. That is 5 years. Each year has 2 periods. So we times 2 to get 10. So this n is 10. Then we get the answer. We get the answer there. It's equal to shillings. The future value is shillings 152 and 80 cents. That is the future value of this bond. Then Roman 2, we have to calculate the capital gain or loss. Capital gain or loss. What do you mean by capital gain or loss? Now, candidates for bond that is held to maturity, there will be a capital loss if the bond is purchased for more than its par value. if the bond is purchased for more than its par value. We read here the value of this bond is 108 shillings and 32 cents. The par value of this bond is 100 shillings, and therefore there is a capital loss because the price is higher than the par value. The value of the bond is purchased for more than its par value. So capital loss is equal to the face value. This is the formula. It's equal to face value of the bond minus the price of the bond, which is equal to 100 shillings minus 108.32, which is equal to negative 8.32. This is a negative, and therefore it is a loss. So the capital loss is 8 shillings and 32 cents. That is part 1, part 2 of that question. So we've answered 1 and 2. That is just a mark. This one is 1 mark, 1 mark. The other one is 2 marks. This one is 2 marks. 2 marks. Then number 3, reinvestment income. We are going to calculate the reinvestment income here. Reinvestment income. Now, what do we mean by reinvestment income? Now, reinvestment income is the interest earned from reinvesting the interim cash flows and the principal payments prior to the final or the stated maturity. The investment income candidates must be generated by reinvesting the semi-annual coupon payments from the time of receipt to the maturity date at the semi-annual yield to maturity. And we calculated here the semi-annual yield to maturity was 3.5%. You understand? Let me take it again. Reinvestment income is income, in our case, that will be generated after reinvesting the coupon payment of 3.5%, because the interest here, the yield to maturity is that the coupon bond is 9%. So the interest here is 9%. The par value of this bond is 100 shillings. That is the par value, is 100 shillings. And we read that the interest is earned semi-annually. Semi-annually. So after every 6 months, the investor earns 9% of 100 divided by 2, because it is semi-annual, which is equal to 4.5 shillings. That is the interest that is earned. But reinvestment income will then be the income that investor receives after reinvesting this interest. So interest, the income that is earned from this interest that will be reinvested, is what we are referring to as the reinvestment income. Reinvestment income is the interest earned from reinvesting the coupon payments prior to the final or stated maturity of 10 periods. Here we have 10 periods. these 10 periods. You understand? So the income that is generated is reinvested. You understand? And that is what you are required to calculate. So it is reinvested at the end of every period. At the end of every period. So we are going to calculate this interest at the end of every period. At the end of every period, like period 1, we will receive the interest, then reinvest it. Then in period 2 will be received, then it is reinvested. Period 3 will calculate the interest 4.5%, then we reinvest it. So we are going to calculate at every period, then we get the total. That will be the reinvestment income. So you are going to have a column here for the period. We have 10 periods. This 5 times 10. Because it is 5 years, interest is earned semi-annually, and therefore the period will be 5 times 2, which are 10 periods. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 periods. 10 what? 10 periods. Then we'll have here periods reinvested. Periods reinvested. We'll have a column for periods reinvested. So we have the first 6 months. The period 1 is the first 6 months. The first 6 months. All right. So that interest that will be received after the end of the first 6 months is going to be reinvested for how many periods? It is going to earn this reinvestment income for how many periods? That will be 9 periods. The interest that will be received at the end of the second period, which is at the end of the first year, will be reinvested for a period for 8 periods. Will be invested for 8 periods. The interest that will be received at the end of the third period, that is after 1.5 years, will be invested for 7 periods. The one that will be received at the end of the fourth period will be invested for 6 periods. So it goes down like that: 5, 4, 3, 2, 1, and 0. Now the interest that will be received at the end, that is at the maturity, at the end of the 5th year, which is at the end of the 10th period, that interest will not be reinvested because the bond will be retired after 5 years. So that's why we have 0. Then we are going to have the reinvested income. The reinvested, we'll have a column for the reinvested income. And we've already calculated the interest, which is uniform. The interest is uniform. It's 4.5. How did I get 4.5? It is the annual 9% divided by 2 to get the semi-annual rate times the power value 100 to earn 4.5. That is the interest that will be earned at the end of every period, which will then be reinvested. So this 4.5 will be reinvested. So you are going to calculate at every period. This 4.5 is going to be reinvested. and we need to calculate or determine the amount of the reinvestment income. Reinvested income. Reinvestment income. This is reinvestment. Reinvestment, not reinvested, but reinvestment. Income will be equal to 1.5 into 1 plus R. All right, that will be 1 plus R. Our R is 3.5%, and therefore 1 plus R will be 1.035 raised to 10 periods minus the time minus 4.5 to use to calculate the investment income after the end of every period. So for example here, at the end of period 1, we'll have 4.5 into 1.035 raised to 9. This 9, which is 10 minus 1, gives us 9. Then the amount we get here, we deduct 4.5. 4.5, we have to deduct 4.5 to get the reinvestment income. Now, why are we deducting 4.5? We're deducting 4.5 because after compounding this interest is compounded. We compound 4.5, 1.035 raised to 9. This one is compounded. When you compound, this is what we get. This, when compounded, we have 6.133. This 6.133 combines the principal plus the interest. This principal is this 4.5, which was reinvested. So the 6.133 combines both the interest and the principal. This is equal to 6.133. And therefore, the interest that is earned on this 4.5 will be equal to this 6.133 minus 4.5, minus this 4.5. That's why we are deducting this 4.5 from this total of the principal and the interest. So 6.133 minus 4.5 is now the reinvestment income that is earned after reinvesting 4.45. That will be equal to 1.633. 1.633. You understand? We'll use the same approach. Period 2 will have 4.5, 1.035 raised to 8 minus 4.5. The other one will have 4.5, 1.035 raised to 7 minus 4.5. Period 6 will have 4.5 into 1.035 raised to 6 minus 4.5. Period 5 will have 4.5 into 1.035 raised to 5 minus 4.5. Period 4, 4.5 into 1.035 raised to 4 minus 4.5. Period 3, 4.5 into 1.035 raised to 3 minus 4.5. Period 2, we have 4.5, 1.035 raised to 2 minus 4.5. Period 1, 4.5 into 1.035 raised to 1 minus 4.5. Then the last period we have 4.5 into 1.035 raised to 0 minus 4.5. 4.5. So we need to calculate all these values. Then we get the total. That will be the reinvestment income. It's now the work of the calculator. 1.426 1.225 period 6 1.032 0.489. Next, second period. This one we don't need to calculate because any number raised to 0 is 1. So 1 times 4.5 minus 4.5, this is equal to 0.00. Meaning that there was no income, investment income, at the end of the maturity period. So you're now going to add this total to have the total investment income. These are investment incomes for each and every cash flow. Then we get the total investment income. So the total investment income is 7.79. 7.79. Let's move on to, we are answering August 2023, question 4, that is fixed income investment analysis. Question 4C reads, the following treasury spot rate curve is provided. We have a column for period, year, cash flow, and spot rate. These are 4 periods. Below the table, I read, a 10% 2-year treasury bond is issued in the market based on the 2-year treasury yield of 6%. The par value of the bond is 100 shillings. Required Roman 1. The arbitrage-free value of the bond, 3 marks. Roman 2. The value of the bond using the traditional valuation approach, 3 marks. Roman 3. The arbitrage profit, 2 marks. But first of all, this investment income is how many marks? 3 marks. All this was to earn the candidate 3 marks. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. All these candidates was to earn just 3 marks. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. All these we worked out. The marks are added here. 3 marks. Then part C, Roman 1, the arbitrage-free value of the bond. Arbitrage-free value of the bond. C1. The arbitrage-free value of the bond refers to its theoretical fair market price based on the present value of its expected future cash flows discounted using an appropriate interest rate. So that's the meaning of the arbitrage-free value of a bond. It is the market price based on the present values of its expected future cash flows. So from that definition, you can get the formula. We will easily compute the present value of the expected future cash flows. The present value of the expected future cash flows will be the arbitrage free value of the bond. And we read from this question that after the end of period 1, the expected cash flow is 6%, 6 shillings, year 2, 6 shillings, year 3, 6 shillings. Then period 4, we have 106 shillings. Below the table, we read a 10% 2-year treasury bond is issued in the market based on the 2-year treasury yield of 6%. Yield of 6%. The par value of the bond is 100 shillings. The par value of the bond is 100 shillings. And you can see, candidates, the yield, the coupon is 10%. 10%. The yield is 10%. All right? The yield is 10%. The par value is 100 shillings. And therefore, the cash flow here will be 10% of 100 shillings. Then we divide by 2 because it is semi-annual. All right? It is semi-annual. A 10 2-year treasury bond is issued in the market on a 2-year treasury yield of 6%. The par value of the bond is 100 shillings. So first of all, let us put down the formula. The arbitrage free value of the bond, abbreviated as P, present value, will be equal to the coupon amount, C, over 1 plus S1, where S1 is the spot rate period 1. The spot rate period 1, we add C over 1 plus S1. This is raised to 2. This should be raised to 1, plus C over 1 plus S3. This should be S2. Spot rate 3 raised to 3, plus C. Now the fourth period, we are going to add the par value of 100. So it will be C plus 100 shillings over 1 plus S4 raised to 4. The denominator is the discounting factor. The denominator is the discounting factor. The denominator is the discounting factor. This C is the coupon amount. C is the coupon amount. Is the coupon amount, which I have said is equal to 10% times 100 divided by 2. So this is just 5% times 100 shillings, which is equal to 5 shillings. Now that we've divided these, the spot rates provided in the question, the spot rate for period 1, we can see there is 4.8%. So the spot rate we are going to use here will be 4% divided by 2. For the second period, it will be 5% divided by 2. So this will be equal to 5 over 4 percent divided by 2 is equal to 2.4. 2.4% converted into decimal is equal to 0.024. So this is 1 plus 0.024, which is equal to 1.024 raised to 1 plus 5 is constant over 1 point. The second period spot rate is 5%, divided by 2 is 2.5%. So this is equal to 0.025 raised to 2 plus 5 over 1 point. The third period interest rate is 5.2. 5.2 divided by 2 is equal to 2.6%. Converted into decimal is equal to 0.026. So it's going to be 0.026 raised to 3 plus the fourth period will have 5 plus 100 over 1 point. The spot rate for year period 4 is 5.4%. 5.4% divided by 2 is 2.7%. So it will be 0.027. The rest is the work of the machine. Right? The rest here is going to be the work of the machine. So this is raised to 4. Raised to 4. Raised to 1, 2, 3, 4. So the rest is the work of the machine. So I'm going to punch in all this, then we get the answer. Do you understand? That will give us the arbitrage-free value of the bond. The arbitrage-free value of the bond is equal to shillings 108.66. This is the arbitrage-free value of the bond. That is Roman 1. Roman 2, we are required to calculate the value of the bond using the traditional valuation approach. Now, the value of the bond using the traditional valuation approach, we are going to discount the coupon amount, which is an annuity, using a present value annuity factor. Then we discount the par value, which is a lump sum, using a present value interest factor. All right, you understand? So this will be equal to the coupon amount, which is just 5 shillings. We are going to multiply this coupon amount, we discount it, which is an annuity, with the present value annuity factor, R. Now our R candidates, we will see from the question that this is a 10% 2-year treasury bond, and the yield is 6%. The yield is 6%. So it's going to be 6% divided by 2. So the R will be 3%. 3%, and it is a 2-year treasury yield, 2-year treasury yield times 2. That is going to give us the period. 2 times 2 is 4. So we are going to have this present value annuity factor times the coupon amount. Then we add the par value, which is 100 shillings, the par value times the present value interest factor R 3% N. So these two, that is what we are going to do. That is the traditional valuation approach. The traditional valuation approach. So the coupon amount is 5. We multiply by this factor. This factor, we get it by this formula, 1 minus 1 over 1 plus R, which is 3%. Converted into decimal, it will be 1.03 raised to N, which is 4 over R, 3% into decimal, 0.03 plus the par value is 100 shillings times 1 over 1.03 raised to 4. The rest is the work of the machine. The rest is the work of the machine. So from here, we will use a calculator to get the value of this bond using the traditional valuation approach. This is equal to shillings 107.43. That is the value of the bond. Roman 2. Roman 3, we are to calculate the arbitrage profit. The arbitrage profit. How do we calculate the arbitrage profit? Now, to calculate the arbitrage profit, we are going to deduct the value of the bond, this value of the bond, from the arbitrage free value of the bond. So this will be equal to the arbitrage free value of the bond, arbitrage free value of the bond minus the value of the bond. The arbitrage free value of the bond minus the value of the bond, which is equal to 108.66 minus 107.43. So that is the arbitrage profit. The arbitrage profit is 1 shilling and 23 cents. This is the arbitrage profit. How many marks? Arbitrage profit, 2 marks. 2 marks. Now, candidates, the arbitrage profit refers to the profit made by exploiting the price difference of the same or similar asset in different markets. It is the profit that is made by exploiting price differences, and it capitalizes on temporary market inefficiencies where an asset is priced inconsistently across the markets. That is the arbitrage profit, and in this case it is just 1 shilling and 23 cents. Roman 2, you are calculate the value of the bond using the traditional valuation method, 3 marks. 1, 2, 3 marks. Here, arbitrage free value of the bond, 3 marks. Formula, working, 3 marks. So we worked out August 2023 question 4, fixed income investment analysis that was done by the CIFA candidates. Thank you for attending the lesson. Make sure you go through the video one more time. Then you can check from our books, revision books. Let me show you a sample of the book.
Welcome to Manifested Publishers.
Hello Lana, welcome to Manifested e-learning forum. My name is F.A. Emlyn Ngwiri, a practitioner within the financial services industry in Kenya. We are looking at advanced portfolio management with a specific focus on managing funds against a bond market. Today's lecture, we are going to learn about the advantages and disadvantages of a bond portfolio strategies or of bond portfolio strategies. If you recall, previous lecture, we had learned about the strategies, the bond portfolio management strategies. We had mentioned about pure bond indexing as the first strategy. We went ahead and looked at enhanced indexing by matching primary risk factors. We also learned about this other third strategy, which was saying is enhanced indexing by larger risk factor mismatches. We went ahead and moved ahead along and learned about active management by larger risk factor mismatches before concluding and looking at full-blown active management strategy. To kick us off advantages and disadvantages, we are going to follow that same order by starting with the first strategy we had looked at, pure bond indexing. Pure bond indexing. We start by discussing about the advantages. The first advantage of pure bond indexing, number one, is that it has the same risk factor exposures as the index, because we are dealing with an indexing strategy, so the risk factors are actually exposed to a greater degree. So we can say that it has same risk factor exposures, same risk factor exposures as the index, as the index. Second advantage, number two, is that it has low tracking error. Low tracking error. It means that the ability of the portfolio, pure bond indexing, to detach or track the index is increased. So it tracks the index to a greater degree or to a greater extent as compared to the subsequent strategies which you are going to look at. The third advantage is that it has, we can say, it has got, in terms of the restrictions, it is actually very restricted, and we are saying that that is going to be looked at as form of a disadvantage there. And we can say that it has low administrative and advisory fees. Low administrative and advisory fees. What does that mean? It means that the charges that the portfolio manager would charge the portfolio, or would be able to charge, maybe say the fund manager, or would charge the firm that they're managing the portfolio on behalf, is actually considered to be low. So if it has got low administrative and advisory fees, it's the most sought after portfolio strategy. Now let's move on and look at the disadvantages on this other side. Disadvantages here. The first disadvantage, number one, is that it is expensive. In that, because you want to earn a return that is similar to the index, then it means that you must really replicate the allocations of the index to close to 100%. And trying to identify the index weighting proves to be quite expensive, and so that's why we're saying that it is costly. So we can say that this is also costly to implement. The second disadvantage is that it has got low expected returns. Low expected, small e there, low expected returns. It means that because you're earning a return that is similar to the index, then you are restricted towards earning only returns or the same risk factors as the index. You don't have that capability of trying to beat the market there. Third disadvantage is that we can say because it's pure bond indexing, it's considered to be it's less attractive. It is a less attractive strategy. So less attractive strategy in the financial services industry. In the financial services industry, it's not sought after because of the issues about low expected returns and the rest. But if for managers who want to earn a return similar to the index, especially during periods of very erratic movements in inflation, then you'd expect this strategy to be sought after. But because of the cost element, it's really not very attractive to many portfolio managers. So just to recap about pure bond indexing strategies, the advantages, we're saying that the first advantage is that it has got same risk factor exposures as the index. The second one says that it has low tracking error. The ability of the portfolio to track the index is actually low, or detracting itself or trying to earn a return beyond the index is actually low. That means that it exposes the portfolio to same risk factors as the index. The third one says low administrative and advisory fees. Moving over to the disadvantages, we are saying that it is expensive in the sense that it is costly to implement. The second disadvantage is that it has low expected returns. The returns that are earned from this strategy is low. The third disadvantage is that it is less attractive. It is a less attractive strategy in the financial. It is less attractive strategy in the financial services industry, and hence it is less used within the industry. We move on and look at the second strategy after pure bond indexing. So number 2, over here, number 2 is enhanced indexing by primary risk factors. Enhanced indexing by primary risk factors. Primary risk factors. There. Start by looking at the advantages. There. So enhanced indexing by primary risk factors, the first advantage is that it is affordable, less costly to implement than pure bond indexing. Indexing means that if it is less costly, then most portfolio managers or a significant amount of portfolio managers would be able to try and seek this strategy their own. Number 2, you can say that increased expected return, there means that as opposed to pure bond indexing, you're able to get a return or to try and enhance the return capabilities under this strategy over here, which is actually an advantage. The third advantage is that it is a strategy that has got slightly a tracking error is an element over here, so that is going to be a disadvantage there. The key disadvantage is that it has got the same risk exposures. Yeah, because I'm looking at, and that's why I was actually turning around, looking at it, trying to look at enhanced indexing by primary risk factors. It means that you have exposure towards primary risk factors similar to the index there. So we have same risk factor exposures, same risk factor exposures as the index, There. We move on and look at their disadvantages. There. The first disadvantage we're saying is that it has got tracking error, increased tracking error, the ability of the portfolio to track the index is increased over here, and that acts as a disadvantage there. Number two, we have low expected returns. This one tends to have low expected returns. Like that. So those two disadvantages are the ones that, or pitfalls, are the ones that actually make this strategy not be most sought after. We can say that, can add on and say that this is also slightly, since you are saying it's less costly, we can also add another disadvantage and say it has, number three, over there we can say it's also less attractive, not less attractive. We just say less attractive, like that. So enhanced indexing by primary risk factors has the advantages of being less costly to implement than pure bond indexing. It has increased expected returns. Third one says has the same risk factor exposures as the index. The disadvantages, number one, increased tracking error. The ability of the portfolio to track the index is increased, or it detaches from that ability to track the index slightly. Second disadvantage is that it has low expected returns. The third one says it is less attractive, it's less sought after, but of course it is slightly more sought after as compared to pure bond indexing there. We can move on this other side and learn about enhanced indexing, third strategy over here. Third strategy is enhanced indexing. It's almost similar to that strategy over there, and we're saying it's enhanced indexing by small risk factor mismatches. By small risk factor mismatches. Risk factor mismatches. There. So start by looking at the advantages. Yeah. It's almost, like I said before, it's almost similar to enhanced indexing by primary risk factor, by indexing by primary risk factors. And the first advantage we say is that it has got the same duration as the index. So number one, same duration as the index. This means that as you construct the portfolio like so, this is the portfolio that is inclined towards fixed income. We are saying that if the duration, general duration over here is 10 plus years, of bonds with maturities, then you tend to have or tailor the portfolio so that it can be able to have liabilities that have got similar to 10 years or so that now you can be able to use that strategy to honor those obligations or those payouts as and when they fall due. So same duration as the index. Number 2, we are saying that it has got increased expected return. Increased expected return. There. Once you have increased expected return, because you're saying it's almost similar to enhanced indexing by primary risk factors, we are saying it has got reduced restrictions. As compared to this enhanced indexing, we have got reduced manager restrictions. So number 3, reduced manager restrictions. Like that. So you can kind of do something or something extra, as opposed on one leg you're trying to earn a return that is similar to the index, but now you're saying that now we're going to utilize some strategies, some additional kicks into the portfolio, such as duration matchings, what tries to enhance the component of returns for that manager there. So for the disadvantages, we can now look at the disadvantages. Disadvantages. The first one we are saying is that it has got increased tracking error. Increased tracking error. The ability of the portfolio to track the index and becomes more and more detached. Yeah, that's what we are saying. Then we are seeing increased risk. Generally, increased risk. Yeah, of the portfolio. So you are exposing the portfolio towards now increased elements. Duration. We are also talking about something such as trying to identify undervalued bonds over there. So there's that exposure towards risk. Then we also say that there's increased fees. Increased fees, like so. So in brief, just to sum up, enhanced indexing by small risk factor mismatches. Saying the advantages, the first advantage is that it has the same duration as the index. Second advantage says that it has increased expected return. The third one says that it has got reduced manager restrictions. Those are the only 3 advantages. The disadvantages, first one says that it has got increased tracking error. Second one talks about increased risk, because you are increasing the portfolio towards external elements to enhance the return capabilities. The third one, you're saying increased fees, because you're saying that you're trying to identify undervalued bonds and overvalued bonds, so that now you can be able to try as much as possible to magnify the return capabilities of the portfolio. Now we can move over on this other side over here, and to sum up the strategies in terms of the advantages and disadvantages, we will look at the full-blown active management. So full-blown, number 4. Actually, it's not going to sum up. We are going to look at the 4th strategy. Sorry about that. So the 4th strategy is active management. Active management by larger risk factor mismatches. By larger risk factor mismatches. My apologies. I had said that this is going to be the final one. But under active management by larger risk factor mismatches, we're saying you're going to use elements such as duration, trying to identify undervalued bonds, and also trying to look at return enhancing capabilities, such as maybe exposing the portfolio towards external elements, such as so I had mentioned duration. We are talking about undervaluation over there, And now the third element that you need to consider over there is value, relative value. Yeah. So these three in unison are supposed to be utilized to try and magnify the returns and the return capabilities of this strategy here. So we start by looking at the advantages. So advantages. There. Active management by larger risk factor mismatches. The first advantage is that it has got increased expected return, increased expected return, expected returns. So you expect this strategy to have a high element or high capability of earning more returns because of using those three elements I was telling you about a short while ago. The second one is the second advantage is that it has got reduced manager restrictions. Reduced manager restrictions. Like that. So those are the two advantages of active management by larger risk factor mismatches. We can move on and look at the disadvantages of active management by larger risk factor mismatches. Disadvantages. Disadvantages. The first disadvantage we can say is that it has got increased tracking error. Increased tracking error. Like that. I already explained what tracking error is all about, and it has been very useful in this today's lesson. And we can say the second disadvantage is that it has got increased risk. Risk, like that. So those are the two disadvantages under active management by larger risk factor mismatches. To sum up, the advantages for active management by larger risk factor mismatches is that it has got increased expected returns, and the second one has reduced manager restrictions. On this other side, for disadvantages, it has got increased tracking error and has increased risk. The final strategy, number 5, is full-blown active management. Full-blown active management. So we look at the advantages. Number 1, it's almost similar to active management by larger risk factor mismatches. So it has got increased expected return, increased expected return, returns. Number 2, we're saying reduced manager restrictions, reduced manager restrictions. That. This one, obviously, you'll be able to appreciate that it has also got, it's also exposed to some elements of some fees there. But we're saying that in as far as the advantages are concerned for full-blown active management, we don't have limits on duration. We don't have limits also on duration. Number 3, no limits on duration. The disadvantages, disadvantages. Number 1, almost similar to active management by larger risk factor mismatches. Got increased tracking error, increased tracking error. And number 2, we have got increased risk. Increased risk. To sum up, the final strategy, full-blown active management. The advantages, the first advantage is that it has increased expected returns. The second advantage is that it has reduced manager restrictions. The third advantage is that it has no limits on duration. And as far as the disadvantages are concerned, the first disadvantage, it has increased tracking error. Second disadvantage is that it has increased risk. I can be able to provide you with an assignment as follows. So, assignment. So the assignment will be in relation to advantages and disadvantages of bond portfolio management strategies. So in relation to bond portfolio management strategies, state and explain, or just explain, explain the advantages and disadvantages of, so we talk about the first strategy, number 1, pure bond indexing. Number 2, enhanced indexing by primary risk factors. Number 3, enhanced indexing by small risk factor mismatches. Number 4, active management by larger risk factor mismatches. Active management by larger risk factor mismatches. Then number 5, full-blown active management. So the assignment for this lesson states that in relation to bond portfolio management strategies, explain the advantages and disadvantages of pure bond indexing, enhanced indexing by primary risk factors, enhanced indexing by small risk factor mismatches, active management by larger risk factor mismatches, and full-blown active management. This brings us to the end of today's lesson. Hope to see you in our next lesson, where we will still be continuing with managing funds against a bond market. Thank you, and God bless you.
Welcome to Manifested Publishers.
Welcome to Manifested e-learning platform. My name is F.A.M. Ngweri, a practitioner within the financial services industry in Kenya. We are going to learn about managing funds against a bond market, the specific focus on selecting a benchmark bond index. The subtopic of today's lecture is all about how we can be able to select a bond index. Most often within the financial services industry, individuals and institutions are usually gauged against a benchmark, their performance. Portfolio managers are gauged against benchmarks. The benchmarks could either be internally constructed or they could be externally constructed, say by the exchange. When selecting a benchmark bond index, there are certain risks that need to be considered. The first risk that you need to consider is market value risk. Market value risk. We can say the following, that the market value of long dated securities or instruments, long dated instruments, the market value of long dated instruments are more sensitive to changes in yield. So we have the price yield relationship actually existing, where we have the price and the yield of a fixed income instrument. When the prices increase, the yield goes down. If the prices go down, the yield increases, like so. So from the side of the investor, whether institutional investor or individual investor, this position is most favored, where you have increased returns. From the perspective of the portfolio manager or the institution that has issued the bond, they would prefer this scenario here, where they are going to be entitled to pay lower yields as compared to the prices of, with the increased price of the bond or of the fixed income instrument. So we can continue and add some statement over here and trying to factor in the element of the risk aversion score or the risk averse investors. We can say the following, that the greater the risk aversion, the greater the risk aversion, avoiding risk, the shorter the appropriate maturity of the portfolio, and the selected benchmark, and the selected benchmark. So if investors avoid risk, we are saying that it would be better for portfolio managers to try and select short-dated securities. They avoid risk. And we are saying, just to recap, market value risk, that the market value of long-dated instruments are are more sensitive to changes in yield. The greater the risk aversion, the shorter the appropriate maturity of the portfolio and the selected benchmark. That is the first type of risk. The second type of risk, number 2, is income risk. There. Income risk is related to how much income you're managing a fund, and you're managing a fund against, say, to service some short-term requirements. So this is the portfolio right over here, and the obligations are usually short-term, or you want to manage a portfolio that can be able to provide cash flow. That. So this portfolio that you construct, this individual X over here constructs, should try and meet these short-term cash flow requirements. So that presents a risk when you manage the portfolio, because imagine this is a short-term portfolio that you formed over here, and you want to invest in long-dated securities, long-dated fixed income instruments. The impact that has is that you will be able to get, you'll be able to have what we call mismatch between the portfolio itself and the cash flow requirements that the investors actually require. So we can mention something that if client is dependent on cash flows, if a client is dependent on cash flows from portfolios, from the portfolio, the cash flows should be consistent. The cash flows should be consistent, and of low risk, and of, or be of low risk, and be of low risk, be of low risk. The longer the maturity of the portfolio, the longer the maturity of the portfolio and benchmark, the lower the income risk, that. So we need to factor in the element of income. How much income does the investor actually require? Is the income of the portfolio concentrated on short-dated instruments or longer-dated instruments? For example, if you're saying we are managing a portfolio for life assurance, obviously you'd expect that, because life assurance usually has long-term implications, then you'd be able to obviously invest in a fixed income instrument that is longer dated, maybe say 15, 10 and above years fixed income instruments. The third type of risk, before I look at the third type of risk, saying that income risk, if a client is dependent on cash flows from the portfolio, the cash flows should be consistent and be of low risk. The longer the maturity of the portfolio and the benchmark, the lower the income risk. So individuals should favor longer dated papers or instruments. The third type of risk is credit risk. Credit risk. And this is just basically the risk of default. We can say that the benchmark credit risk, benchmark credit risk, benchmark credit risk should be closely matched, should be closely matched, closely matched. There. This means that the portfolio and the benchmark should have or should be exposed to similar risk return profiles, similar risk and return profiles, similar risk and return profiles. Saying that the credit risk, the benchmark credit risk should be closely matched, and this means that the portfolio and the benchmark should be exposed to similar risk and return and profiles or characteristics. Moving over on this other side, we look at the third and final risk element while selecting a benchmark bond index. Number 4, talking about liability framework risk. We can say that the liabilities of the fund should mimic the expected portfolio, Simply put, we're saying that if we have investments which are long-term in nature, then you should be able to have liabilities, and maybe you intend to fund liabilities maybe at the end of, say, the next 20 years, like that. So these are the liabilities like that. We're simply saying that the liabilities should actually mimic whatever the objectives are actually being created over here. The objectives against the constraints. The objectives include the risk and return components, whereas the constraints include the liquidity needs, the legal needs, the unique circumstances, the time frame, and taxes. That. So in every respect, we should expect that the assets over here, which are long-term in nature, should actually be of make sense when trying to fund the liabilities thereon over here. That said, we're saying that the liability framework risk, the liabilities of the fund should mimic the expected portfolio. I have an assignment for you. Today's lesson assignment. Number one. Explain the risks that affect benchmark, a bond index, So you can say number 1, market value risk. Number 2, income risk. Number 3, credit risk. And number 4, we are saying liability framework risk. Liability framework risk. Liability framework risk. The assignment that I have for you today: explain the risks that affect a benchmark bond index. To be specific, market value risk specific to bond index, market value risk, income risk, number 2, number 3 is credit risk, and number 4 is liability framework risk. This brings me to the end of today's lesson. Hope to see you in our next lesson. Thank you and God bless you.
Welcome to Manifested Publishers.
Hello Lana, welcome to Manifested e-learning platform. My name is F.A.M. Ngwiri, a practitioner within the financial services industry in Kenya. We are going to learn about techniques used to align risk exposures of a portfolio. Specifically, going to look at the following 4 techniques or duration measures. So the first one is duration itself. Duration. I believe that under fixed income, you could have come across this term duration. So we are going to delve into understanding of what duration is within a portfolio context. The second item we are going to look at is key rate duration. Key rate duration, which is a related concept to duration, and we'll be able to also dive into the understanding of what it measures. Number 3, we are saying is present value distribution. Present value distribution of cash flows, like so. We are going to understand how we can be able to align risk exposures in the sense that we're trying to create a map between what the portfolio is offering and what the benchmark is also offering, or trying to create an alignment between the duration the present value distributions of the benchmark against that of the portfolio. The fourth and final item under this subtopic, we are going to learn about issuer exposure. Issuer exposure. We are going to try and understand how we can be able to ensure that similar alignment or similar exposures of the portfolio should also be that of the benchmark, or to try to ensure that there is normalcy or similarity in terms of exposures based on the issuer, because you could be managing a portfolio or a fixed income portfolio that is based on issued by corporations, or what we call corporate bonds, like that, since our major topic is on fixed income portfolio management. So these are the 4 items that we are going to have a focus on as we understand the techniques that align the risk exposures of a portfolio. To start off, I will have to explain to you what is needed to ensure that we can be able to have a valid comparison. When I mean when portfolio managers try to have a valid comparison between the benchmark returns and the portfolio returns. The benchmark returns refer to the returns that have been earned by a benchmark. Benchmark in the fixed income airspace could be, for example, the FTSE bond index, Financial Times Securities Exchange bond index. This is what you're saying is the yardstick that we use to measure or to compare the results of the fixed income portfolio return against. That's what I mean. If the FTSE bond index earned a return of about maybe say 15%, given holding period could be 1 year, it could be 6 months, could be whatever period, and during that same holding period, the fixed income portfolio earned a return that was about say 13%. The yardstick that that investors or portfolio managers could be able to refer them as PMs use is to compare the return over here against over here. So what was the cause of that difference between the return of the benchmark and that of the portfolio? So we are saying that for a valid comparison, you need to ensure that the risk exposures of the portfolio should be similar to that of the benchmark. That is specifically when you're trying to focus on pure bond indexing strategy. So we can put pen to paper and say that for a valid comparison, it is useful for portfolio managers or for PMs, for portfolio managers, so to match what we can say the risk profile of a portfolio, the risk profile of a portfolio to a benchmark. We are saying that before you select a benchmark to actually compare results against, portfolio managers' results against, we can be able to identify key characteristics of a benchmark. And the key characteristics, I'd like to summarize them as using this mnemonic called samurai. So when trying to identify a valid benchmark, it can be specified in advance. The benchmark should be specified in advance. The benchmark should be appropriate in terms of trying to compare the results against the portfolio. It should be a proper yardstick that can be able to compare your results against. So it should be appropriate, should be measurable, it should be unambiguous, it should be reflective, it should be, we're saying it should be investable over here, and finally, it should be not similar to appropriate, but it should be accurate in terms of trying to measure the results or try to measure the returns component of the benchmark itself. So we can say then that this is a proper mnemonic to try and guide portfolio managers in trying to identify a valid benchmark. We can continue it from over there and say that the portfolio and the benchmark risk profile and the benchmark risk profile, can be measured and be measured against duration, or using the following measures, using the following. Semicolon there. The first item is one, we can say duration. Number two, key rate duration. The third measure, can say duration contribution. Others including spread duration, and distribution of cash flows. Number five, distribution of cash flows. So we are saying that for a valid comparison, it is useful for portfolio managers to match the risk profile of a portfolio, and stress that, of a portfolio to a benchmark. The portfolio and the benchmark there, write that over here, portfolio and the benchmark risk profile can be measured. So we're talking about the risk profile. The risk exposures of the portfolio can be measured using duration, key rate duration, duration contribution, spread duration, distribution of cash flows thereon. Please note that there'll be special topics that we will be able to learn about duration, key rate duration, and these items, all of these 5 items thereon. However, the techniques used to align risk exposures over portfolio, of course, include duration, key rate duration, and we're talking about distribution of cash flows, as well as issuer exposures, like I had mentioned at the onset. Under pure bond indexing, what you need to understand is that pure bond indexing strategy tries to earn a return similar to the index. So you're saying that the index return was moving and like that and ended up getting maybe say something inclined towards 15% return. That what was the portfolio return generating? 12%. So you need to look at what we call gap analysis. What was the cause of that difference in returns? Could be that you might have exposed the portfolio towards less risk exposures as compared to the benchmark, and this is what you're saying is the benchmark, BM, like that, and this is the portfolio, P, there. So you could have exposed the portfolio towards less risk, maybe duration. You could have been selecting maybe bonds which have got shorter terms to maturity. And maybe the benchmark has got longer terms to maturity. Of course, the variability of returns for portfolios with longer durations tends to be slightly erratic as compared to ones which are shorter term duration. But the effect is actually felt more when you invest in portfolios with short term durations as compared to long term. So we're talking about the impact in terms of the impact on the portfolio there. So for pure bond indexing, we're saying you're just trying to mimic the returns that is similar to the index, mimic the returns of the index. So if the index return is going to be, or the index weighting for this benchmark over here, we're saying that we have corporate bonds, or rather, because you're looking at fixed income, yes, you can be able to say treasury bonds allocation was maybe say 15%, like that. And then corporate bonds was maybe say 40%, like that. So this is 55%. And then maybe you could be able to have a medium-term note, which is also a fixed income instrument. It could be maybe another 15%, like that. So this is 70%. So 70, then you can be able to see the balance over here, 30%. Could be put maybe say into some items such as maybe say commercial paper, CP, like that. But of course, this one is also a short term. Let me say maybe you put it, or we can be able to change even the allocation. Yes, let's just leave it as commercial paper, like so. So CP, like that, 30%, totaling to 100%. If this is the allocation for the benchmark like that, then for us to form the portfolio value, which is separate over here, if you are managing a fund that is worth 100 million shillings like that, then it will be the proportion for treasury bonds be 15% times 100. That corporate bonds will be 40% times 100, 15% 100 like that, or we're just saying is 15 million or something like that. Then we are saying that the commercial paper will be 30% times 100. Right? So we are saying here is going to be 30 million, 15 million, 40 million, and 15 million allocated towards those fixed income instruments like that. That's what we are saying, pure bond indexing. Though expensive, we are saying that portfolio managers should try as much as possible to reduce the exposure, the cost element, and in so doing, they'll be able to at least maximize the returns of the portfolio, rather because of that element of cost. Because we're saying that portfolios usually charge a management fee, incentive fee, and what we call portfolio management fee. So we are going to reduce that significantly. So you only pick a sample of the bonds in the index. So we can put a pen to paper and say that under pure bond indexing strategy, risk exposures, the risk exposures to match the risk exposures of the portfolio or of the benchmark with that of the portfolio sampling techniques such as stratified sampling is used. So under this stratified sampling, so we can continue over here and explain what stratified sampling involves. We can say under this method, bonds or risk exposures are used to select bonds such as, can say such as sector. We can also use quality rating. Quality rating. We're talking about duration, amongst others. Duration. Then say ETC, etc. Then we get what we call the total value of the bond, ETC, and a total value of the bond and a total value of the bonds is determined. Total value of the bonds is determined. Once the total value of the bonds is determined, the weights of the bonds over here, using this sampling type, the sampling is issued. They're saying the bonds are the weight of these risk exposures over here, sector quality rating, duration is actually identified once you get the total value of the bonds over there. Then the portfolio manager selects a sample once you've determined the total value of the bond. So we can continue on this other side and say, once the total value of the total value of the bond is determined, the portfolio manager gets the weight of the risk exposures in relation to the total value of the bonds portfolio, value of the bond portfolio. The manager then selects a sample from the selects a sample weight. We can say selects the sample weight, selects a sample to include in the portfolio. So what happens is that first of all, you try and identify, we're saying, a pure bond indexing strategy to match the risk exposures of the benchmark over here, with that of the portfolio. Sampling techniques such as stratified sampling is used. Under this method, risk exposures are used to select bonds such as or based on sector, quality rating, duration, amongst other measures. Then a total value of the bonds is determined. Of course, this is also done on the benchmark, or this is actually done on the benchmark. Once you've determined the benchmark or itemized the benchmark based on sector, quality rating, and duration, then the portfolio manager gets the weight of the risk exposures in relation to the total value of the bond portfolio. Then the manager selects a sample to include in the portfolio there. So this is what we're saying is very common in financial services industry, where you don't pick all of the bond weightings based on the weightings in the index. What you do, you pick a sample. The same way you'd be able to go into a hotel and have a buffet, you decide to pick a sample of whatever you feel will actually be beneficial to your body, and then you'd be able to consume it once you sit down on the table like that. It's the same principle over here. Here you try and identify the benchmark that actually exists. You try and identify the risk exposures of the benchmark, and you now select a sample of bonds which have got risk exposures, or which expose which will expose the portfolio to similar risk exposures as the benchmark, and you include inside your portfolio, so that now you can be able to align the risk exposures of the portfolio with that of the benchmark. And common measures of how to techniques, or the usual techniques of how to align risk exposures, utilize duration. So number one over here, we can say duration. First technique used to align risk exposures of a portfolio is duration. We can say that duration is a measure of a one-time parallel shift in the yield curve. One-time parallel shift in the yield curve. This is what I mean. if you're talking about the yield and rather the price and yield to maturity for bond, and you find the bonds which are like that, because of changes in, say, for example, prevailing interest rates, exchange rates, and the rest like that, then you find that, or macro factors, the GDP, so on and so forth, macroeconomic policies, then you find that there'll be either a one-time parallel shift either below or a one-time parallel shift slightly above like that. We're not talking about a scenario where you have the price and yield to maturity moving like that and like that. This is not parallel. It's actually moving or change of the position of the yield curve from there to there. This is also a change in position of the yield curve, but we're saying in this scenario over here, it's a parallel shift in the yield curve, and over here is a non-parallel shift in the yield curve. But this is a significant macroeconomic policy that might impact on the value of the bonds. So they're saying that duration is a common measure of how to align risk exposures of a portfolio. So we try and use the yield curve. If the yield curve has moved from a one-time parallel shift in the yield curve as a result of change in macroeconomic policy, then you also need to adjust the portfolio or to expose the portfolio to similar risk factors that can be able to try and propel the portfolio towards the shift either upwards or downwards, that matter there. Number two, second technique, second item to use is key rate duration. Key rate duration. We're saying that it's related. I'd say that it is related to duration there. We can say that this is based on the twists, shifts and twists of the yield curve. And it should be now what was explained before, like that. It's a shift, it's a twist in the yield curve. It was initially moving in that direction, but now because of changes in GDP or macroeconomic policies, then it actually changed and actually inverted from that position to that position like that. That could be something that, or a technique that is that could be able to expose the portfolio to similar risk factors. What I mean is that looking at duration, which you are saying is a measure of interest rate risk, we can be able to identify the risk factors that caused that shift of the portfolio or of the yield curve to move from over there to over there. So if there are significant risk factors that actually have changed the yield curve to move from there to over here, like that, then you try and identify those risk factors for this current scenario over here. Those risk factors could be maybe spread duration, or maybe the longevity, the length of exposure towards longer dated papers. You could be able to now concentrate your portfolio or rebalance the portfolio, the fixed income portfolio, so that you can be able to invest in longer dated papers, maybe say for 15 years to maturity and greater, or maybe even to 30 years to maturity. Initially, maybe the portfolio was having duration or time frame that was around or averagely about 10 years to maturity. But now, because of this result over here, of this shift in the yield curve over here, then you could be able to maybe extend or even shorten it, because we are saying that in this scenario over here, it would be good to actually shorten or concentrate the portfolio towards short-term maturities thereon. Is a measure of sensitivity of a portfolio. Talking now in this case about a fixed income portfolio, to twists, shifts, and twists in yield curve. Yield curve. And under fixed income, you must have learned about the yield curve and why it is useful in trying to determine the duration of fixed income instruments. So under fixed income unit, you could have been able to learn and you can't be able to also refer to the manifested publishers and fixed income study packs, as well as the revision kits for more insights. The third component is present value of dividends, distribution. Present value of distribution. We are saying that present value distribution. Under present value distribution, we can say that it measures the proportion of index, move over on this other side, proportion of the index to the proportion. We are saying it measures the proportion of the index to the duration attributed to the cash flows. Attributable to cash flows. Attributable to cash flows within a set time period. Within set time periods. So how is the portfolio able to try to distribute the incomes to investors? That is what we're saying, that we can be able to try and align the distribution of the index to that of the portfolio. Say supposing the index is expected to distribute the interest payments after every 6 months, but now the composition of the portfolio, like so, fixed income portfolio, like that, every 6 months. So that means for the next 15 years, you select bonds which have got maturities in between over here to ensure that consistency in terms of the income. So you could be able to now, for 15 years, average life is 15 years. So you could be able to select 7-year bonds. You can be able to also have in the portfolio 10-year bonds, and here maybe 7-year bonds could be allocated, maybe say 10%, 7-year bonds. And over here, 10-year bonds, you could allocate maybe 30%. Then maybe say 12-year bonds, you could put maybe say 40%. So this is 70, this is 80%, and maybe say 15%, 15-year bonds. You could put maybe 20% like that. So this is what we're saying is the present value distribution. You can be able to ensure that at least for the next 7 years, you're going to be receiving bonds, you're going to be receiving interest payments that is of a given amount. But now, as you can be able to see that you're invested in 7-year bonds that remember you've invested today. You're investing in 7-year bonds, 10-year bonds, 12-year bonds, and 15-year bonds. All of these will be able to distribute interest every 6 months. So what happens, this 7-year bond will distribute maybe say for the next 7 years intermittent cash flows like that, which will overlap onto this 10-year bond. Remember that we've invested in these bonds today. Yeah, so this is not a percentage, sorry, this is just the years. So you invested in all of these bonds today. The next 7 or after 6 months, like that, we will receive payments from this one, this one, this one, and that one. And after another 6 months, we'll receive payments from these ones, like that. Because we're saying that since we've formulated that portfolio of ours, and today over here, every 6 months, we'll be able to receive cash flows. Remember this, that after 7 years, this one will be able to pay the last principal component, the last interest component, and the principal value will be paid after 7 years. This one, principal plus interest will be paid after 10 years, the last payment. This one after 12 years, and this one after 15 years, and like that. So we are saying that the present value of distribution needs to be considered when formulating a portfolio, when trying to form a portfolio to provide sufficient liquidity to service, say, maybe future liabilities. There. The fourth perspective, fourth component, is the issuer exposure. Under this item, we are saying that the portfolio manager could try and ensure that the issuers could be, maybe say these ones over here, corporate bonds, that, and here are medium-term notes. Here we have treasury bonds, like so. You do not want to expose the portfolio to significant default risk, what we call credit risk. So what you do, you have a greater proportion allocated towards treasury bonds, a greater proportion, as medium-term proportion allocated towards corporate bonds, or an intermittent proportion, or maybe moderate proportion allocated towards corporate bonds, and medium-term notes, and maybe you'll have a very small proportion like that. So you do not want, when we talk about issue exposure, is that if the index has got an exposure over here for treasury bonds, maybe say to the tune of maybe 70%, over here maybe 10%, and over here maybe say 20% exposure, like that, then you should try as much as possible to mimic the index allocation so that we can be able to align the portfolio to risk exposures similar to the benchmark there. So this is the benchmark allocation like this: treasury bonds 70%, medium-term notes 10%, and like that. So we do not want to expose ourselves or the portfolio to significant default risk, and hence we should follow the allocation similar to the index there. So it refers to the allocation provided by different issuers. Under issue exposure, we're saying it refers to the allocation provided by different issuers. So what is similar to the index is allocation in terms of the issuers. Then you should be able to also try as much as possible to ensure that you allocate similar to the index there. To recap, we have learned about the techniques used to align risk exposures. The first technique is duration, which measures interest rate sensitivity to one-time parallel shift in the yield curve, right over here, saying that duration is a measure of one-time parallel shift in the yield curve. We have also learned about key rate duration, which we're saying is a measure of sensitivity of a portfolio to shifts and twists in the yield curve. Third, we have learned about the present value distribution, saying that it measures the proportion of the index to the duration attributable to the cash flows within set time and periods. And finally, we have talked, or we have looked at the issuer exposure, which refers to the allocation provided by different issuers. I want to give you an example of how we can be able to identify risk exposures in form of a matrix like that. And if you're kind enough, you can be able to just try and follow as I try to explain how it actually works within financial services. So we have the following risks. So we have risk here given to us here, and we have the interest rate. So the type of risk is given to us over here in form of a small table over here like that. Then we can say the measure risk, and we can say what is measured is measured. And we can be able to bring about over here brief extension, measure used. So the risk moves like so. You're saying that these represent primary risk factors. We're talking about interest rate, yield curve, one-time parallel shift in the yield curve, spread, like that. Then talk about credit. Talk about the credit quality. They are like that. These are the risk exposures. So what is measured? You're looking at interest rates over here. We are saying exposure to yield curve shifts. Exposure to yield curve. Exposure to yield curve shifts. The measure used over here, you already explained it, it's duration. And a yield curve, here we're talking about shifts and twists. What is measured? Shifts, shifts and twists. This is a topic under fixed income. Please refer to the manifested e-learning platform or even the manifested publishers study pack. Shifts and twists, and we are saying present value of dividends, present value distribution, classified to as present value distribution, or we can say key rate durations or key rate duration. That. So for more clarity, under spread, maybe I could be able to change this and maybe put it in maybe a different color over there so that you can be able to see the risks could be interest rate, yield curve, spread, and credit like that. And what is measured are these ones that we move along and towards the right, and what measure is used, we can be able to move like that also to the right there. So exposure to spread changes, spread changes. That or differences between the buying price and the selling price, what we're calling or what you're referring to as the bid-ask spread changes. And this one we call spread duration. This one we will be able to, as we move along with under fixed income and portfolio management, we'll be able to see how the spread duration is actually measured. Finally, credit changes. So changes in credit quality of the fixed income instrument. Saying over here we use duration contribution. That. As well, duration contribution is also a small subtopic which we'll be able to learn about in our subsequent classes thereon. So this is just a summary of bond risk exposures for non-mortgage-backed securities or for fixed income instruments which are utilized within the financial services industry. And so these, what it measures and the measures actually used are these ones here. You need to be able to appreciate all of these measures. We shall be able to look at them in our subsequent classes in more detail. Assignment. Briefly explain techniques used to align risk exposures. Techniques used to align risk exposures. Techniques used to align risk exposure. So briefly explain techniques used to align risk exposures. We have looked at them. I believe we have understood them. And this brings me to the end of this lesson. Thank you and God bless you.
Hi candidate, welcome to another session of Manifested Online Classes. In this session, I want us to continue with the topic of public sector accounting standards, and specifically I want us to look on a standard or a public sector accounting standard regarding the accounting, recognition, and also the measurement of the property, plant, and equipment. And specifically that standard is IPSAS number 17. So basically IPSAS number 17 is equivalent to International Accounting Standard number 16, which prescribes now the recognition, measurement, and presentation of property, plant, and equipment by what we refer as the profit oriented entities. But IPSAS 17 prescribes the accounting, the recognition, and presentation of the property, plant, and equipment by what we refer as the public sector entities. When talk about the public sector entities, you have to recall that these are those particular entities which usually specialize in terms of providing essential services to the members of the public. These entities, their objective is not to make profit. Now, under this particular standard here, that is IPSAS 17, we're going to look on something to do with the recognition, the measurement, and also the presentation of the property, plant, and equipment in the books of accounts and also financial statement of the public sector entities. But before we look on all those particular aspects, recognition, measurement, and presentation, first of all, we need to define the PPE, property, plant, and equipment, as defined under IPSAS 17. So we can say that PPE, that is a property, plant, and equipment, that these are the tangible assets. These are tangible assets. Number one, which are held for use in production, comma, a supply of goods or services, all for administration purpose, And number two, it is expected to be used for a period of more than one financial year. Year. So that is the definition of a PP in accordance with the IPSAS 17. Any tangible assets basically means that these particular items must have physical existence, and number one, they are used in production or basically supply of goods or even provision of services or for administration purpose. And number two, this particular asset are long term. In other terms, they are expected to be used for a period which exceed one financial year. Then from there we can look on something to do with the recognition of PPE. So when talk about the recognition of PPE, according to IPSAS 17, for a public sector entity to be able to recognize any tangible non-current asset in its books of account and also in its financial statement, then such PPE has to meet two main criteria. Number one is that that item of PPE has to be controlled by the entity. Number two, its cost or basically fair value can be measured reliably, and also it is probable that future economic benefits will flow into the entity associated with that particular what asset. So therefore, you can say for an item of PPE to be recognized, basically to recognize is to record an item of PP in the books of account and also in the statement of financial position. To be recognized, it must meet the following two criteria. The following two criteria. Number one, it is probable. It is probable that future economic benefits will flow into the entity associated with such assets, asset. Or in other terms, we can just say it is probable that future economic benefit now will flow into the entity and which is generated by such a financial what asset. Number two, we say its cost or fair value. Its cost or fair value can be measured reliably. So if these two criteria have been met, that the cost or even the fair value of such an item of PP can be measured reliably, and it is probable that there are some future economic benefits which will flow into to the entity and which are generated by such an asset, then you're saying such an item of PP should be recognized in the books of account and also in the statement of financial position as an item, or basically as an asset. Then from there we can proceed and look on something to do with the initial recognition, or basically the initial measurement. What do we mean by the initial measurement? Initial measurement, you're talking of the value at which an item of PP should initially be recorded in the books of accounts of a public sector entity. According to IPSA 17, any item of PP which has been acquired by a public sector entity should be recorded in its books of accounts in accordance, or basically it should be recorded at the cost which has been incurred plus any other related cost, So therefore, in this case, we can say that PPE are initially recognized at cost, and any other related expense incurred in bringing an asset to its intended use, and maybe also location, to its intended use and what location. So therefore, all items of PP are initially supposed to be recorded or recognized at the cost now which was incurred in acquiring those particular assets, and also any related cost which is incurred in bringing an asset to its intended use and also what location. Good examples of this particular cost which will be incurred in bringing an asset to its intended use and also location. These will include things like the installation cost. If, for example, a public sector entity has acquired a machine, that machine is to be installed. That is supposed to be capitalized and included as the cost of the asset. These will also include things like the delivery cost, and so on. So all these are the other associated costs which are incurred by a public sector entity in bringing now an asset to its intended use, and also what a location. So then from there we have something to do with the subsequent measurement. And basically the subsequent measurement, now we are talking of the value at which these particular items of PP should be recorded in the statement of financial position after initial recognition, after items of PP are initially recorded in the books of account. So then at the end of each year, they should be recorded in the statement of financial position at which value. Now, according to this standard, IPSA 17, subsequently or at the end of each year, these items can be measured by a public sector entity or can be recorded in the statement of financial position of a public sector entity using two models. We have the cost model, whereby the items of PP will be recorded in the statement of financial position at cost minus any depreciation minus any impairment loss, and then we have the revaluation model. So therefore, in this case, we can say subsequently PP can be measured using the following two models. So the first model is the cost model. Model, and number two, we have the revaluation model. So we have said at the cost model here, PPE or the property, plant and equipment will be recorded in the statement of a financial position at their net book value or their carrying amount, of which this particular net book value or the carrying amount, this is equal to the cost minus the accumulated depreciation minus any accumulated impairment loss. Losses. So then at the other model, which is the revaluation model, so here the items of PP will be recorded in the statement of financial position of a public sector entity at their fair value, meaning that all items of PP at the end of each year, they will have to be revalued by a professional valuer to their fair value. And basically, then when a public sector entity is preparing the statement of financial position, they are recorded there at their fair value. And also, it is important to note that any revaluation gain or loss, this one will be recognized as part of other comprehensive income in the statement of financial performance. In the statement of financial performance, which is prepared by what we refer as the public sector entity. So that's, or basically those are the two models which may be used by a public sector entity in terms of determining the value at which the various items of PP should be recorded in its statement of financial position. Then from there we can look on something to do with the depreciation. First of all, when we talk about the depreciation of PPE, we are talking of the estimated loss of money value of or basically estimated loss of money value of the property, plant and equipment. Now, this particular standard here, that is IPSAS 17, it requires the public sector entity to estimate the value these items of PP have lost at the end of each year, of which there are two methods which are recommended to be used in terms of estimating the depreciation at the end of the year. The first method is the straight line method. Whereby the depreciation per annum of PPE is computed based on cost. So means that to compute the depreciation per annum, we take the cost of the PP times the rate of depreciation, and then we have the other method which is called the reducing balance method, reducing balance method. And under this particular method here, the depreciation per annum of the items of PP is computed based on the net book value or the carrying amount of the PP times the rate of depreciation. So therefore, we have those as the two methods which are recommended for use by IPSAS 17. Then next we can look on the something to do with the impairment or basically recognition of impairment. And equally, IPSAS 17 here recommends that if the recoverable amount of the PP has reduced the carrying amount, then an impairment loss should be recognized. Essentially, it is important to note that the items of PP should be recorded in the statement of financial position at the recoverable amount. The recoverable amount basically is the amount now which the entity or a public sector entity can recover or basically can get after selling the items of PP. So always the carrying amount in the statement of financial position should be equivalent to the recoverable amount. But if it happens that the recoverable amount is less than the carrying amount, then something called an impairment loss should be what? Should be recognized. Of which IPSAS 17 recommends that if there is some evidence showing that the items of PP may be impaired, then public sector entity should proceed and actually determine an impairment, the impairment loss, which is always the difference between the carrying amount and the recoverable amount, and which should then be recognized as an expense. So therefore, you can say IPSAS 17 requires public sector entities to recognize impairment loss, or to requires public sector entities to carry out, let's just put it like that, to carry out impairment review if evidence exists, which shows that PP could be impaired. PP could be impaired. And in this case, we have said that the impairment loss will only be recognized if the carrying amount is the same with the net book value of items of PP. If this one is basically more than the recoverable amount, Basically, remember you have said that the recoverable amount is basically the value which now, or the amount of money which a public sector entity can be able to get after selling an asset currently. So if this particular amount here is less than the carrying amount, then an impairment loss should be recognized, of which now the impairment loss, this one is computed by taking the carrying amount minus the recoverable amount, in which case we have said that this impairment loss is supposed to be recognized as what? As an expense in the statement of financial position prepared by a public sector entity. So that is the issue to do with the impairment. And then we can look on something to do with the recognition of PP. The recognition of PP. So what do you mean by the recognition? The recognition, first of all, is the removal of an item of PP from the public sector entity statement of financial position. So it is the removal of a previously recognized items of PP. So in this case, according to IPSAS 17, there are two instances when an item of PP may be removed or may be recognized from the statement of financial position prepared by the public sector entity. So which are those particular instances? One is when an item of PP has been disposed, or in other terms, it has been sold. And number 2 is when an entity do not expect to receive any future economic benefit from what? From an item of PP. So therefore, you can say PP should be recognized, should be recognized, should be recognized when, number 1, they have been disposed, they have been disposed. They have been disposed. Basically, to dispose an item of PP is like to sell, is to sell. And number 2, when no future economic benefits, no future economic benefits are expected from the asset. No future economic benefits are expected from the assets. No future economic benefits are expected from the asset. So those are the 2 instances under which now an item of PP may be recognized or basically can be removed from the public sector entity statement of financial position. So next, I think we can also discuss the issue to do with the disclosure requirements. Disclosure requirements. Disclosure requirements. So the disclosure requirement basically refers to the information which must be disclosed as far as the items of PP are concerned. According to IPSA 17, a public sector entity must disclose in the financial statement and also in the notes the following information relating to items of PP. Number 1 is the measurement basis. Measurement basis adopted by the public sector entity. So the public sector entity will need to explain which measurement basis it is using or model it is using. Is it using the cost model or the revaluation model? Number 2, the depreciation method equally which has been used. Which method has been used in terms of determining the depreciation per annum of the various items of what? PP. So the other information which is to be also to be disclosed is the useful life. Useful life of PP. And the other information which is also to be disclosed is the gross carrying amount. Gross carrying amount. So in this case, when talk about the gross carrying amount, you're talking of the net book value. And the other information which also need to be disclosed is what we refer as the accumulated depreciation. Accumulated depreciation of PP. And 6, or final number 6, is any impairment loss. Any impairment loss which was recognized. Any impairment loss recognized during that year. So therefore, these are some of the details which a public sector entity is expected to disclose as far as items of PP are what are concerned. So therefore, as far as IPSA 17 is concerned, those are some of the provisions you need to know, because what you have said is that what IPSA 17 does is basically to prescribe the accounting treatment of items of PP to ensure that this particular, or to ensure that the measurement, the recognition, and also the presentation of the various items of PP is appropriately done in the books of account and also the statement of financial what position by what refer as the public sector entity. So once we come back in our next session, I want us to look on a certain illustration from the past papers, and equally I will also give some assignment as far as this particular subtopic is concerned. So see you in the next session. Hi candidate, welcome to another session of manifested online classes. So in this session, I want us we continue with the IPSA 17, that is International Public Sector Accounting Standard number 17, which prescribes the accounting treatment of the property, plant and equipment. And specifically, I want us we look on a question which was tested in the sitting of December 2023. That is specifically question 1D. And then from there, we'll also give some questions which you can be able to use for your revision purpose. So let's first of all, we look on this small question, which was question 1D for December 2023. So the question reads, explain the term heritage assets as applied at the International Public Sector Accounting Standard number 17, which governs accounting recognition measurement of PPE, and give suitable examples. Number 2, describe 3 characteristics of a heritage asset. So, and that particular question had 6 marks. So what the examiner here was requiring is for the candidate to explain what are heritage assets, and number 2, to give the various characteristics of heritage what asset. Now, generally, what are heritage asset? So these are those particular assets which reflect now the history, or basically which are rich in history, and also the culture, or basically the values which were observed by various ethnic group in the past. And therefore, in terms of how we can define this particular heritage asset, we can say that a heritage asset is an asset of a historical, cultural, and environmental significance, significance. So basically any asset, for example, which reflects some of the events which occurred in the past, or basically any asset which reflect now the culture and also the values which were observed by the communities in the past. Now, what are good examples of this? What are good examples of historical, not historical, rather heritage assets? So we can talk of examples of a heritage asset include number 1, we have the old buildings. We have the old buildings. So basically, this is a good example of what we refer as the historical, not historical, rather heritage asset. In other terms, you can also refer to this as historical buildings. Buildings. We can also talk of what we refer as monuments. We can also talk of what we refer as monuments. We can also talk of maybe work of art, which was basically done in the past. We can also talk of what we refer as the natural reserves. We can also talk of the conservation areas, and so on. So therefore, these are basically some of the good examples of what we refer as the heritage asset. The old or historical buildings, the monuments, the work of art, what we refer as the natural reserves, and also the conservation areas. So then from there, in Roman 2, the examiner here was requiring the candidates to give 3 characteristics, or basically to give 3 features of these particular assets, which are known as the heritage asset. And we can talk of a number of characteristics of this particular asset here. Number 1, we can talk of rarity. Rarity, basically, this comes from the word rare, basically what this means is that this particular heritage asset, they are not readily available. In other terms, we can say they are very what? They are rare. So we can say the heritage assets are rare, i.e. they are not readily available. Basically, before you come across a heritage asset, basically, or in other terms, we say these particular heritage assets. Heritage assets, they are not what? They are not readily available. Number two is that this particular heritage asset, they are rich in history. They are rich in what? History. Basically, this particular heritage asset, they reflect some of the events which occurred in what? In the past and so on. So therefore, in this case, we can talk of historical significance. And we say that they reflect some of the events which occurred in the past, which occurred in what? In the past. So that is basically the other characteristic or the other feature of this particular what? Heritage asset, that they are what? They are rich in history, because now they tend to reflect some of the events which occurred in what? In the past. And also number three, we can talk of a cultural value. Cultural value means what? Some of these particular historical assets, they embody, or basically they reflect some of the culture, or basically some of the values which were observed by some of the ethnic groups in what? In the past. So we can say they embody the values and practices observed by ethnic groups in the past. So therefore, these are some of the features, or basically some of the characteristics of the heritage asset. Number one, you have said they are very rare. Number two, they are of significance or historical significance. They basically reflect a lot of events which occurred in the past, and also they have some cultural what? Value. So basically, some of them show the values, some of the practices which were observed by some of the ethnic groups in what? In the past. So that basically what the candidates here are required to do, basically to explain three features, or basically three characteristics of this particular heritage asset. And basically by doing that, explaining what is a heritage asset, giving examples of heritage asset, and also giving some of the features, the candidates were getting what? We're getting 6 marks. Then as we wind up, I want to give some questions here for which will help you for your revision purpose. So, and I can read, it reads, in context of IPSA 17, International Public Sector Accounting number 17, describe the following. Number one, the criteria for recognition of property, plant and equipment, 4 marks. Roman 2, initial measurement of PPE, that is property, plant and equipment. And number 3, you are also required to describe, or basically to give the disclosure requirement of the PP, and we have 6 marks there. So make sure as you go through the video, basically what you have covered in our previous session, you then attempt those particular questions. So that brings us to the end of that particular session, and what you have been able to cover there is the provisions of IPSAS 17, which generally we have said is a standard regarding the recognition, the measurement, and the accounting treatment of the property, plant, and equipment. So see you in the next session as we look on the other international public accounting standard.
Hello and welcome to the lesson. Today we are going to answer question 5, fixed income investment analysis paper that was done in April 2023. Question 5A, I read, with reference to fixed income constructs, distinguish between the following terms. Roman 1, maintenance covenants and incurrence covenants, 2 marks. Roman 2, affirmative covenants and negative covenants, 4 marks. I repeat, with reference to fixed income contracts, distinguish between the following terms. 1, maintenance covenants and incurrence covenants. 2, affirmative covenants and negative covenants. So we have, on the one hand, maintenance covenants and incurrence covenants. So maintenance covenants are conditions that borrowers must continuously meet throughout the life of the contract. Maintenance, continuously. The lenders or borrowers must continuously meet throughout the life of the fixed income contracts. On the other hand, we have the incurrence covenants. These are conditions that borrowers must meet only at specific times. All right? Occurrence, from the word occur, specific times. Usually when taking certain actions such as issuing new debt or undertaking certain activities, that is when certain conditions must be met. Do you understand? Now, maintenance contracts require the borrower to maintain certain financial ratios, such as the debt to equity ratio, or what we call interest coverage ratio, at specific levels. And breaching a maintenance covenants contracts could trigger default penalties and so on. So I've given examples of what is required of a maintenance covenants on the part of the borrower. All right? The occurrence contracts, I've said, restrict borrowers' ability to incur additional debt or undertaking certain activities without obtaining prior approval from the lender. And unlike maintenance covenants, incurrence covenants do not require continuous compliance, but come into play when the borrower takes specific actions. The borrower takes specific actions. So those are the distinguishing features between the maintenance covenants and the incurrence covenants. It's just 2 marks. 1, maintenance contracts or covenants. Let me use the word covenants. I've said that here the borrower must meet certain conditions continuously. They are conditions that borrowers must continuously meet. Are conditions that a borrower must continuously meet. a borrower must continuously meet. The incurrence contracts or covenants, under incurrence covenants, these are conditions that borrowers meet only at specific times. Are conditions that borrowers meet at specific times. Are conditions, incurrence covenants are conditions that borrowers meet only at specific times. So that's the difference between maintenance covenant and incurrence covenant. Then Roman 2, we have the affirmative covenants. Affirmative covenants. What are these affirmative covenants? Now, affirmative covenants are obligations imposed on borrowers to take certain actions. Affirmative covenants are obligations that are imposed on borrowers to take certain actions or maintain certain conditions. And these actions typically involve providing regular financial statements, maintaining insurance coverage, paying taxes,